of this panel is none other than Sfiso Spier. You've heard from him already, Head of Investments at the GEPF. And he's joined by Thabo Letlaka, the Deputy Chief Investment Officer at the Eskom Pension Fund and Provident Fund. Leslie Ndawana, who is the Principal Executive Officer at the National Fund for Municipal Workers. Sipho Makubela, the Chief Executive Officer at Harith General Partners. Ngatia Kirungi, who is the Managing Director at Spearhead Africa, and Vuyo Hlompotoy, who's the Joint MD at African Infrastructure Investment Managers. Over to you, Babu Spear. Your microphone. Oh, you got it.
Good morning, everyone. So infrastructure investing is a persistent theme which has become more apparent during the COVID epidemic as more countries ramped up infrastructure spending as a stimulus mechanism. However, wide-ranging and competing needs on the fiscus has meant that governments the world over have been unable and currently are unable to shoulder the cost alone. This then places a demand and opens an opportunity for private providers of capital, and which is what we are discussing on this panel today. So the perspectives covered will be of pension funds of various sizes. It will be the advisors of pension funds, and it will be investment managers who are in the forefront of infrastructure investing. So in our panel today, as introduced, we have Sipho Makubela, who's the CEO of Harith General Partners. We have Leslie Ndawana, who's the Principal Executive Officer of the National Fund for Municipal Workers. You have not Patuchetso, but you have Thabo Letlaka, who's the Deputy CIO of the EPPF. You have Ngatia Kirunge, who is the MD of Spearhead Africa. And lastly is Vuyo Hlompotoy of AIM, which is the African Infrastructure Investment Managers. They'll be presenting in that order that I've specified, and this will be followed by a brief discussion at the panel. We'll then conclude by inviting comments and questions from the audience. So first up for their presentation, it's Sipho, who will discuss and give an overview of Africa, the need for Africa for investing in infrastructure in the African continent. Thank you.
Thank you and good morning. I was hoping to see my presentation on one of these, so I thought to always just look up. Can you put on one of your monitors if you don't mind? I'll get started. I'm Sipho. It's a pleasure and a privilege to be here. I think we've pulled the short straw. Everybody's tired, so we'll try and not bore you by and kill you by PowerPoint. But just briefly, really, let me just talk for a minute about Harith so that for a second, at least you have a sense of why I even qualify, not that I really am that qualified to talk on this thing. We are, as Harith, 17 years old. We've been investing on the continent for that long. We have investments in over 10 countries across the continent. The continent is not one small little place. It's 54 countries. We manage over $1.2 billion. We also have regional funds. We've got the regional fund in Nigeria that does West Africa. We have a regional fund that also invests in Namibia. And over and above that, we are also having a renewables fund. That just gives you a good sense. So Africa and infrastructure is primarily what we invest in. Let me just chat to you about, where's my clicker now? Can somebody help me with this? It's not moving. No, there it is now for a second. I don't know why. Okay, it's working now. Let's get to it quickly. I'm going to run through these so that we have time. I'm just setting context so that in our conversation, excuse me, we have at least an informed view. It's always not good to assume that we all know. But let's get to it. And I'm just starting with a problem statement, really. The continent is not connected at all, right? So 36% on average of the continent is what we have to connectivity, not even broadband, to be true to you, just connectivity to the internet, whereas the global average is certainly just about double that at 62%, right? So you can see a big deficit as it is already. Then this is quite staggering, right? Only 45%, well, 45% is within 10 kilometers at best of the nearest fiber network connectivity, right? So when we talk about fiber, obviously we're talking about the fastest broadband that there is available, at least to date, and it's what fires literally what we know today as connectivity. And if you have this level of displacement, the impact is actually obviously quite felt downstream. It's a big problem, certainly from a development point of view going forward. But what you see in that is the green is certainly where the biggest concentrations are. And you can see, yes, right, maybe Southern Africa is certainly well connected. We happen to be invested in CIVH. A big part of that is that. You have connectivity in West Africa, and then Kenya. Outside of that, everybody else is nowhere near where they should be from a reasonable level of fiber connectivity, right? We're dark, just put it simply. You know, when you look at our power needs, they were nowhere near. The continent is generally having about 1.4 billion people from a population point of view. 600 of that does not have access to power at all. That's a staggering number, and that just gives you a good sense of how big and grave the infra need is. When you then look at transport, you know, I've put in peers there. I'm not going to go through all of them, but we have a huge land mass. That's known. That's given. We're a big continent, but we just don't have rail. We don't have any sustainable form of road networks that is meaningful to talk about, compared certainly to peers who have similar or even lesser surface areas, right? So when you start having that kind of a problem, you have a good sense of what's going to happen to trade and the ability for us to trade with each other. And I will touch on trade issues just now, right? And there you are. So you when you talk about intra-trade and you look at intra-trade compared to peers, we are nowhere, right? So intra-trade for the continent is at just sub 15%, and the slide before, when I spoke about roads and I spoke about transport, fuels that problem as a reason why we don't trade with each other. So the whole after as we know it, and what Lumkile is doing becomes a key part of addressing these problems from an infra point of view. Water and sanitation, we just don't have any reasonable level of water and sanitation, right? 780 million people primarily on the continent don't have basic access to sanitation. And remember, I said that's 780 over 1.4 billion. That's a huge number, right? And it's just basic sanitation. We're not talking anything that is fancy and modern, just basic access. Big problem, right? Then another 411, just basic, clean drinking water. It's a human rights problem, right? I'm not going to be granular with everything that I've got there. You can see how we compare to peers now. When you then, compare what the continent has compared to, I haven't even gone to developed economies that are far advanced to us. It's just trying to find, and this is also quite wrong because I'm comparing a continent to countries, right? But you realize that we are certainly from an infra point of view on these, we're at the bottom of the pyramid globally, right? Let's chat to this. I think the minister yesterday touched on this, and I'm glad that Dondo has just walked in again. But let's put some context. And this is the number that I've put $100 million there, but that $100 million talked to literally in 2017. That deficit was per annum $100 million. That number today, $100 billion. Dollars that we need to invest per annum between now and 2040 for us as a continent to get to some level of parity with the rest of the world, right? That number was 100 million then. That number today is 170 million billion dollars, and that's per annum. That's a significant deficit that we're facing, right? And again, I mean, I think the point that the minister made yesterday, and rightfully so, is sorry. How can I go back? Okay, is that 170 excludes the SDGs, right? So when you include the SDGs, you can see the delta. The delta is actually quite staggering. It's just over 200 billion, right? Now the slides are moving themselves. Who's controlling my slides? I'm impressed. And they just moved. Okay. Is that me? Okay. So let's have a look and see where the deficit is underpinned, right? Sectorally. You can see roads and transport. Sfiso, can I use your mic? Is it better? Because I can move quicker. Okay, you can see where the deficit primarily needs to be met, right? So road transport talks to what I spoke to about earlier as a big thing. So we need to invest a lot in our roads. Digital infrastructure certainly remains one of the biggest stimulants of growth going forward. And yes, we are not where we should be, but this is a big opportunity for us, right? And I'll talk to that if I've got time at the end, why digital infrastructure is a big opportunity for us. And primarily the bulk of the continent, because we've come so far behind, we've leapfrogged a lot of the technologies that the developed economies have gone through. So technology is one of those where we don't have to start from the very beginning. We literally can start at 5G instead of in some economies, right? You have to go through the evolution of, 3G, 4G, 5G. So there's leaps that we can make. And so investing in telecoms becomes a big thing. Energy is a no need, and I'll just talk to that quickly just now. Why have you not clicked again? Okay. I've gone backwards again, for Pete's sake. Okay. Jesus thing. Can somebody help me with that? I'm not in control of this thing. Okay, I'm just going to move on from here. Leave what I skipped, right? So the needs, I think they need to be contextual. So there's continental needs, that's great, but who and where are our needs compared to the rest of the world, right? So on this graphic, okay, that's fine. So this graphic you can see, right, and it's broken down. I just spoke to you about telecoms, energy, and stuff. So the biggest need for the continent on this is put together. So for the whole world, we have the biggest need, but then it's broken down per country. Yes, China is the second, but nobody at this stage in the world is investing in infra more than China. So you shouldn't think that because we are, slightly above China, we're okay. China is leapfrogging that by miles, and they are spending billions when we are not, right? Yes, Brazil and Russia are next, Asia is there, but we begin to see where we are compared to peers, whether it's developed or developing. I've just put that graphic just to give you a good sense of how big is our need and how big is that need compared to peers. Can you get the next slide, please? This is staggering, right? I've given you a sense of that need, but now I'm giving you a sense of, at least from a private investment point of view, how much are we investing and how are we investing compared to peers, right? You can see Africa is at the far end for people who've got the biggest need, for people who have certainly $170 billion to spend per annum. We are spending nothing. And then what this is telling you is slightly dated. As at the end of 22, we had gone down compared to the year before. So we're almost 40% down. Fair enough, you could argue that there was COVID with redirected spend. But instead of closing down the deficit, we've actually widened it. Can I get the next slide? Just giving you a good sense, certainly from infra as an asset class is growing globally, but if you look at where we are as a continent, we are in that little rest of the world, right? Which is $6.4 billion. Let's not get too excited, because you think that we're a big chunk of that $6.4 billion. No, we are not. Next slide in the meantime. Next slide. Zero in on that $6.4 billion. Okay, there we go. Now that gives you a good sense, right? So if you are getting some sense of excitement that, the rest of the world, $6.4 billion, maybe it's not too bad, you can see sub-Saharan Africa is at the very bottom of where everybody else is deploying capital, certainly from raising capital. So the panel before us actually puts this in context, right? If anything, I want to sound defeatist, but if anything, part of the message is you are noise. You are not moving the needle. We're not allocating to you. Yet we've got the biggest opportunities. We've got the biggest needs. So I think there's certainly a need for having engagement on that conversation, because that conversation on us collectively as a continent not having the need needs to be recontextualized. We've got the need, but we've got the returns. We've got risk, but it's perceived risk. At the same time, that capital, we're not asking for the days when the continent was asking for grants is gone. We're not asking for grants. We're asking for investment and partnerships. Let me just move on before I get caught up in that. Where is the little that is coming? Where is it going to? Right? So the little that is coming, you can see a big chunk of it now is going into renewables. So for those of us who yes, and rightfully so, want to talk about clean energy and all the conversation we've been having about ESG, at least the little that is coming is going to certainly renewables as a big chunk. And then you do have digital infrastructure. Again, it follows the needs, and the need is actually quite correct. And then the rest of it is transport, but we know transport is our biggest need. So that picture needs to be quite informed by where the needs are. At this stage, it's not entirely informed. It's almost running with what's the biggest flavor for the day. Renewables are great, but transport is going to be a big part of where we need to spend. Let me close with one or two things. On the ESG side, and everybody in this room sees this slide all the time. The Global North contributes, let's be honest, contributes and has contributed this, significantly to the emissions, right? You see how much Africa contributes. It's 1.5 billion tons compared to, for instance, Asia's 21.7 billion tons. So we're not excusing anything, but we are the least contributor. Right? But when you then look at the Global South, we are the biggest beneficiaries of the downside of these emissions, right? So the Global South has a case to make. We don't contribute as much to the problem, but we receive as much of the problem. And then our counterparts from the Global North don't invest alongside us to solve the effects of these problems. Earlier on, part of the comment was, infrastructure is crumbling because of climate change and all those things. Yes, we have we already had an infrastructure deficit. So what happens when you think of the floods that happened in Libya? That infrastructure is decimated. It's going to need to be invested upon to be restored at least. But that is left to be Libya's problem. We had floods here in Cape Town, was it last weekend? Whatever infrastructure that's damaged is left to Africa, or at least the global south to solve. But the causation of it, we are not partnering with the global north. And I think that's a moral dilemma that I want to leave today with everybody in the room, because it's decision makers here, that we can't talk just transition in isolation. Just transition is the right thing to talk, but part of that just transition is partnering, knowing that the people who are being displaced are not primarily on the causation side. They are certainly on the receiving side. And infrastructure is going to be the one thing that presents that big opportunity for us to partner together in making not only just transition work, but in answering the biggest infrastructure deficit problems that we have as a continent. I'm going to jump and give my colleagues a chance, but what I want to leave with is the need for us to act. Not a need for us to act only on meeting our requirements as a continent from an infrastructure deficit point of view, but a need for us to act to ensure that the little that we are left with as a continent by our predecessors and ancestors, no matter what you think about our continental infrastructure, we've been bequeathed something. We have an obligation to act and leave the next generations not only a better infrastructure set than the one we found, but to leave a sustainably cleaner environment, an environment where we could partner with the global north to create that. Thank you very much.
Good morning to you all, and good to see you again this morning. So I've been given the responsibility to advance a case for investment in infrastructure by retirement funds. I was given 10 minutes to speak on a subject that probably requires me to speak for 1 hour. And I'm not suggesting, like the minister yesterday, that I'm going to speak for 1 hour, 10 minutes. But you know, in business schools, we are taught that you build an argument to the point that you can then advance the argument. So I'm not sure if I am able to build any argument in 10 minutes. So I'm just going to throw to you the arguments. I've already used 1 minute of the 10, so now I'm left with 9. But let's move on. So essentially, I'm going to address this thing from two perspectives. The first perspective is the micro perspective. The second one would be the macro perspective. So as a fund, and you are in a board meeting, looking at you as a fund and probably nothing else, right? The narrow perspective. Why should a pension fund invest in infrastructure? So there are two main reasons that I would want to advance to you. So the first one is portfolio construction. If we look at infrastructure, it's a very important building block for any portfolio. And we know that the free lunch in investment is diversification. So infrastructure has got a totally different risk-return profile to any other asset class that we can look at. But more so in the South African investment universe, we know that the universe is very limited. If you to go to the stock market, probably you're looking at much less than 300 stocks. For bigger funds, you end up being the stock market. So you don't want that. So where you can also get opportunities is in the infrastructure space. If we look at the purpose, all the investments must actually be done with a purpose of improving the lives of people. Where you can make the most impact is actually through the use of alternatives. And much of the alternatives is actually sitting in infrastructure. Then the other block in that point that I'm advancing is returns. So, in fact, if we look at infrastructure, it's arguably, at this point in time, the best performing, if I can call it, asset class. We know it's not an asset class, but let's for the purpose of the conversation, call it an asset class. I've looked at our own numbers as a pension fund. The alternative asset portfolio that we've built, which is probably plus minus 70% infrastructure, has returned just under 13% over the last 5 years to end of August. If I compare those returns with the other returns, you can see the validity and rationality around returns. Whilst I'm talking about 12.2% as the returns in our infrastructure portfolio, we know, I know there are asset managers in the room. The JSC kept SWIX for that same period was 6.1%, bond market just under 8%, cash 5.8%, and the listed market actually negative 3.25% over the same period. So you can see from a return point of view, it's arguably the best performing class. Obviously, for us as National Fund for Municipal Workers, what returned better returns in our total portfolio is the global space. But remember, the global space has got a different risk profile. So from a risk-adjusted point of view, the infrastructure space was actually the best performing space. Then we can look at it from risk management point of view. When you are investing in infrastructure, you've got good control of risk management. You can sit on the boards of the investee companies. You can be part of the advisory committees of the PE funds. You also have got flexibility to choose sectors that you want to invest in and particular assets that you prefer, and you can share risk amongst other investors. If we look at PE funds, if you invest in a 1 billion rand PE fund and probably you're 4 or 5, you've invested 250 million in a 1 billion rand fund, then there's good risk management mechanism in there. You also have got control of the due diligence. And I'm saying this in comparison with equities, for example. Once you give a mandate to an asset manager, let's look at listed space. Usually it's give us a return of whatever the target that you have. The asset manager is going to go choose the stocks to invest in, and you're not directly involved in those decisions in terms of which stocks to pick. Obviously, you need a report, but the control is actually outside of you, so to speak. Then if I can move on to, or let me say from the boardroom to the outside space, the macro space. So if we all look at that chart, if there are trustees in the room, and I'm going to talk to the chart or to the slide, this should make every trustee to go back and have a conversation around investment in infrastructure. So, like the minister said yesterday, and probably my colleague has also indicated, the African Development Bank has indicated that the infrastructure financing gap that we're facing, we're looking at about $170 billion by 2025. That's for the whole of Africa. But we're looking at a third of that being required to service the existing infrastructure, right? And we all know about the ailing rail networks, the need for roads. There's a statistic that I saw that only 45% of road networks or roads that are used by people are untarred. That's not a good statistic. We know we need to have functional bulk water infrastructure. This world is now going towards technology, fintech. If we don't have strong ICT infrastructure, everything collapses. But if we look at the conventional way of financing, like your banking sector, it can never finance infrastructure, right? And we must actually, as trustees of various funds and institutional investors, have that picture. Post the global financial crisis, the risk management systems that banks used became much tighter and tighter. And to the extent that they also need to manage their balance sheet, the sensitivity of interest rates between the asset and liabilities. So if we look at their tenure or the tenure of their liabilities, it's very short term. And that short term has also been reduced significantly post the global financial crisis. So given that, it means there is need for replacement of who is or should finance infrastructure. We all know, and there's a quote there or reference from the ADB as well, that closing the infrastructure deficit is vital for economic prosperity and sustainable development. I've just done some numbers there, and I've put a disclaimer there. Those numbers that I've put there, they may not be accurate, but they are very reasonable. 2-3 weeks back, FISCA published a communique. I think it was talking about trustee toolkit, and they quoted 5.6 trillion as the value of the retirement funds in South Africa. Then I did my simple arithmetic from that number. So I said, if 40% of the 5.6 trillion are funds like your preservation funds, retirement annuity funds, and beneficiary funds, that whose risk profile doesn't allow them to invest in infrastructure, we're left with 60%, which gives us 3.6 trillion, right? And if I assume that all the funds should move towards 10% of their investments into infrastructure, that gives us about 336 billion, right? We know you can move as much as 15%. So I've just used 10%. Then I've said, out of that 10%, probably 5% is already in the infrastructure, in that space. That leaves us with about 168 billion that can be made available towards infrastructure immediately. These are some of the conversations that the retirement funds should have in their boardrooms. From the puzzle that I've put in there, I've spoken about the underpin of economic growth being infrastructure. The World Bank has indicated that poor infrastructure constrained growth by 2%. That is a massive statistic that must also get us to be awakened. When we talk about economic growth, we must link that to issues of eradication of poverty and redistribution of income. In a stagnant economy, it's difficult to redress inequalities. You can't take from Paul to give to Peter in a stagnant economy. But if the economy is growing, you just give those that didn't have. It may be very complex, but it is that simple if we're going to look at it. But in an economy that's growing, issues around financial inclusion and their three-dimension access, quality, cost, you can address them easily. Issues around employment, the prosperity of SMEs, etc., economic development. So these are all important economic issues whose underpin is infrastructure and infrastructure development, infrastructure financing. So if I can go to that next slide. So you can actually see that the conversation we're having in the previous slide, you can come back and marry it to the 17 SDGs. And in fact, almost all of them, they can be linked to infrastructure. Let's take one, for example. One can ask, how does strong institution or strong institutions and justice have to do with infrastructure? Those who understand infrastructure, it's mainly on the basis of project finance. And those who have been in investment banking and in the infrastructure space, you know, in the project finance space, it's a network of financial, interconnected, complex contracts that has got various covenants. So it must give comfort to those counterparties that when I need to enforce these covenants, there's a court that is fair that can help me to enforce those covenants. So I was just explaining one. I can take all the 17 and explain how they are linked to infrastructure, but I'm not going to do that today. I'm just advancing the case for investments in the infrastructure by pension funds. However, having said that, we should also acknowledge the constraints that comes with infrastructure investment, although probably I shouldn't have, because it becomes the conversation again in the boardrooms why funds shouldn't invest in infrastructure. But we also need to talk about those and have solutions to that. The issues around bankable projects, issues around the appropriate instruments that we can use as pension funds, the risk appetite. But issues like risk appetite, as long as you've got the right instruments, you've got the right understanding, as I've indicated in the last 8 minutes, then you know that then you have got reasons to get that decision to invest in infrastructure. Thank you so much.
Thank you. We'll have Thabo do the next presentation.
Good morning. The previous two speakers spoke about time to act, and I heard the previous speaker speak about appropriate instruments, as well as the minister yesterday saying that the industry must develop appropriate instruments, and that's really what I'm here to talk about today. I got a call yesterday from Patu, my fellow deputy CIO at the EPPF, giving me the hospital pass to basically take this one for him. So this is a last-minute call-in. So I will stick to his slides when they come up loosely, and I'll make some points before getting to those. Okay, so I'm here to talk about EPPF's listed infrastructure vehicle. We've been working with partners in the industry to develop this vehicle, and it's important for me to say right off the bat that we are still working on it, so it's not a final completed product yet, but something we hope to bring to market soon. But I just wanted to share we wanted to share some of our thinking to date on this. It's a listed vehicle, and so one might ask, how is that different? Oh, there we go. I'm just catching up on the slides. Okay. And as I said, I'll come back to these. How is our listed vehicle different? Listed in the SA context, of course. Different to infrastructure funds that exist out there currently. Ultimately, they're both trying to do the same thing: crowd in assets for infrastructure investments. And so, really, what is our kind of differentiated offering here? And really, for us, it's a matter of the focus, and we're saying that our vehicle is really focused on other asset owners. We're trying to crowd in other asset owners, and the attractive bit there is a matter of fees. We're saying that the typical infrastructure fund will tier fees according to size of allocation, and we're saying that in our listed vehicle, the fees will be shared across all investors, and really there'll be no tiering of relative to size of allocation. And so we're saying that everyone who comes in, whether you're a big fund or a small fund, you'll be charged plus minus the same level of fees. So we're hoping this is attractive to smaller asset owners as we try and crowd in assets for this asset class. The next question that we've been asked in our journey of development has been a question around liquidity. Who will be providing the liquidity? You're saying you're listing, therefore, who's providing the liquidity? And we're saying that we're proud to say this is an EPPF initiative, and so we're stepping up as the EPPF in this vehicle to provide the liquidity. So there's some sort of bid offer spread there that we're putting out to the market, saying please come in, please join us as we invest in this vehicle. But as I said, we've been working with industry partners, and so in time, even what's beginning as an EPPF initiative, we're saying in time will possibly evolve and become an industry initiative. But at this point in time, we're providing the liquidity for this vehicle. And so we've also been asked, what are we saying of our fellow fund managers, asset managers out there? And what role do we see them playing in this vehicle? And we're saying that we do see the role as a collaborative and as our partners. We're saying that we see deal sourcing, co-investing still kind of as an important partnership between us and asset managers. However, for this particular vehicle, at this point in time, the fund management itself, we're saying we're going to as the EPPF do that up front. And as I said, as this evolves in time, the fund management activity might be potentially farmed out to someone else. It's important to mention our fiduciary responsibility as well. And the question that comes up here is, what's the asset mix? Is it more of a social fund? Is it, are the assets in the fund, sorry, in our vehicle more economic? And we are saying that considering our fiduciary responsibility, and again, this has got to do with our long-dated liabilities, and you're seeing some of the points on the board, high risk adjusted returns, the hurdles we need to meet. We're saying that a massive focus is still the member ultimately, and so this vehicle doesn't in any way change that for us. And so the mix of assets inside the vehicle will still predominantly be economic as opposed to social, roughly a 2/3, 1/3 split, and so that's the focus. And really, another kind of point of interest we're hoping for other asset owners is one where we're saying we're a fellow asset owner, and we aren't really driven by profits. And so kind of all fees and all costs within the structure are really on a cost recovery basis. And so we're hoping this is attractive, again, in comparison to other infrastructure funds that exist out there at this point in time. And then the focus of this fund at this point in time is South Africa. So South African assets will be in this vehicle. And we're saying at this point in time to meet other liquidity issues, it'll also be a debt-focused fund. So those will be the assets within the fund. So I've covered this slide. Okay. Just to cover this one, these are some of the issues we've been dealing with. And again, we are trying to attract other asset owners to join us. And so hopefully I've answered some of these questions around other funds asking themselves the question around liquidity. You're seeing then that one, that thought bubble about the fact that demographics in a particular fund might lead to a particular fund having to come to us and say, look, we want some liquidity. As I said, we're providing that liquidity. As all infrastructure vehicles and funds, some of these issues like the infrastructure assets are too risky to invest in, or not being able to fund investable projects are hopefully dealt with again in that pooling vehicle. Right, lastly, to land this, as I said, it's a vehicle we're setting up that's entirely focused on infrastructure. We're providing the liquidity, like I've said. There's efficiency that comes from central origination and obviously managing DD costs. And the management, fund management will be the EPPF. And then lastly, and our CEO spoke of it this morning, when we think about private market investments, really we look at private markets investments through the lens of really these three things, these major three themes: social injustice, economic disparity, and environmental decay. And we're saying really in all our investing in private markets and impact investing, we're trying to address these three major categories. And then lastly, again, in alignment with the previous speaker, we're also looking at SDGs as well as kind of a main focus. And really, we've asked ourselves the questions, which are the main ones that really speak to our thinking? And we've highlighted there number 4, 6, 7, 8, 7, and 9. I won't read them out, but really those are our major, our main focus as it pertains to SDGs. Thank you.
Thank you to Thabo. And then next we have Ngatia.
Good morning once again, everyone. My name is Ngatia Kirongi. I am the CEO of a firm called Spearhead Africa. It is a financial advisory firm based in Nairobi, and we work with institutional investors. These are the local pension schemes, insurance companies, as well as the commercial banks with their investments into alternative assets. One of the initiatives that we run, essentially, to the previous speaker's point, is an initiative to bring together these local pension schemes to address some of those questions that have been raised. We're too small to make a difference. It's hard for us to find opportunities. We don't even know where to start. So what we did is that we brought the local pension schemes together to form a consortium called the Kenya Pension Fund Investment Consortium, or KEPFIC for short, which was our way of trying to harness, the power of multiple funds coming together to jointly try to make a difference. So The topic I was asked to speak on was on the allocation trends into infrastructure by Kenyan pension schemes. Now, that would have taken me less than 5 seconds, really. It would have taken, it's just one sentence. We've gone from 0 to 0.01, probably. We stop there. But that is, as sad as that may be, I will say we're very excited for that 0.1, and it's actually 0.2. I think what I would like to focus on, now that we have heard the why and the what, large infrastructure funding gap, infrastructure is good for diversification purposes, and the likes, I would rather talk about the how. How are we moving from the low levels we are to where we want to go? I'll start off with this slide. This slide really speaks about recently, or maybe not so recently anymore, but some announced transactions, mainly in the public-private partnership space. And what you'll see here is investments into Kenya's infrastructure. You have an expressway for about $500 million. You have a major road connecting two of our largest cities for about $3 billion, and another for about $1 billion or so. Now, what we like to highlight in this slide are two things. First of all, these are private companies or private partners that have come together to work with the government, or in many cases on their own, to invest in Kenya's infrastructure. And there's only one reason they would ever do that, and that's because investment into infrastructure is lucrative. There's no way around that. We've heard that everyone has a fiduciary duty. So if we can remember that, then you'd understand why you have a lot of offshore investors that are looking to invest into our markets. The question that we always ask is, where do these private investors get their money from? Well, they mobilize it from their own institutional communities. Their own institutional investor networks, from pension schemes, from asset managers across the globe that have seen the benefits of infrastructure investments in general and emerging markets specifically. And they have either seeded third-party funds that will be investing in these opportunities or are doing so directly. Now, you can see in front of you some of the largest investors in the world. The question has always been, where are the local pension schemes? And here we say Kenya's pension schemes, but we can also ask the same for the rest of Africa. We can ask, where is the ESCOMs here? Where are the GEPFs and the likes? How is it possible that you have Africa's infrastructure being developed and the returns from that African infrastructure being developed really to the benefit, at least in terms of returns, to other pension schemes? Why not our own? And the reason why that is important is, and I think you've heard from a number of speakers before me, about diversification. And then, diversification is really key, not just for the biggest, but also for smaller pension schemes. You can see our size of industries is about $13 billion, 1.6 trillion shillings, and that's expected to almost double, in fact, more than double in the next 5 years. What's the opportunity set, though? You can see that pension schemes in Kenya are highly concentrated in fixed income securities. And those fixed income securities are not corporate bonds. These are sovereign bonds. These are our own government-issued bonds. You can see over 75%. And equities being a small chunk thereafter, about 16%, and then you have property and a little bit on offshore. Now, what's the danger of that? I mean, just looking at that chart, you can see that we are overexposed to fixed income. And fixed income in terms of the government side is barely making real returns. Most of our funds are diversified into all three or all four main asset classes. And you can see that inflation being negative, at 9.2%, our total returns have been, below optimal. We're talking about 3.7%. With equities really dragging down our performance. I think we heard from one of the previous speakers that the JSE has over 300 companies. In the Nairobi Stock Exchange, we have about 60, but really only 5 of those are actively traded, and those 5 really have resulted in a negative 16.6% return for the last 1 year. So we really do need this diversification into alternatives, into infrastructure, into private equity, and the likes. Now, the how. Oftentimes, we ask the regulator, what is the regulator doing to help make this shift into these alternative assets? I can tell you right now, our regulator is not the problem. As you can see in front of you, these are asset categories that essentially allow pension schemes to invest into alternatives. And if you combine in property, REITs, private equity and venture capital, infrastructure, which includes affordable housing, as well as any other asset, that comes to about 90%. Meaning that today, if a pension scheme decided that we are going to be very aggressive on alternatives, the regulator has allowed them to do so. And they can put up to 90% of their assets into these opportunities. So it's not a regulatory problem. It's actually for us as investors to recognize the opportunity set and then now take advantage of the same. So what is holding us back, or what has been holding us back that we're trying to address? The first is that there was limited awareness of the opportunities in the first place, right? And that's because pension schemes have not traditionally been seen as a source of funding, a source of financing for infrastructure projects. But even if we were, there's limited investment expertise internally, definitely. I've told you we're looking primarily at bonds, at government bonds. So how are we meant to really understand the risks behind investing in a power plant? Very difficult. And so what that does is that it limits our investment appetite, or at least risk appetite. We heard about the large investment size. I showed you these are billion-dollar worth opportunities, single opportunities. And we have very many small funds. And these small funds wonder, how do we get involved in any of this? The size of the opportunities are too large. Hence, the importance of pooling mechanisms like we have just heard. And finally, there was regulatory uncertainty, which is really, what does the regulator think about pension schemes that are managing retiree money or expected retiree money, and in the future? No one wants to fall afoul of the regulator. I think that's true everywhere. So what does the regulator think about us investing in infrastructure? I told you before, the good thing is that our regulator has made it perfectly clear that we can do so. So as GEPF, this is just a snapshot of our current membership. There are a lot more than this, but I just wanted to show you that it's a combination of both public and private sector funds, because the problems, the challenges, the requirements are the same regardless of where your sponsor is from. It really does not matter. The second, it's also a combination of both large and smaller funds. Yep, pension schemes, that is. Again, the challenges faced with the biggest pension scheme, as you can see there, we have the National Social Security Fund, which is the largest scheme in the region, is the exact same as one of the smaller, more private sector funds. So we work with both, and really we work with both together with the support of our partners, USAID and the World Bank Group, that have supported us from our inception, as well as local, or at least the industry stakeholders like the Capital Markets Authority, the Nairobi Securities Exchange, and our Fund Managers Association that are also very critical partners in our mission. Now, we are not a fund. I just want to make that clear. We are more like an association. We're not out here trying to get funding from these pension schemes and then essentially have them being limited partners and us as a GP, and then we go and invest. No, that's not what we're doing. We're trying to help these pension schemes look at each opportunity, and these opportunities can be direct or they can be through third-party funds. So we try to help them assess these infrastructure and alternative investments, which you can see in the green box there, together with their fund managers, and by that, hopefully, they would then now invest into one of the third-party funds that are looking to participate into infrastructure opportunities, or directly into these projects themselves. So we essentially bring two things to the table. First is we bring the investment opportunities that have been screened and selected based on a very objective investment criteria, and then we also help with the capacity building. Let me pause to give you guys a sense of why this is important. We have had just about every credible global fund manager come to see our members. From BlackRock, Blackstone, you name it. And they come, and we all know, most of us know that they are very credible managers. They have the track record to back that up. However, if you don't understand the strategy behind some of these fund managers, it boils down, their proposition boils down to one of trust. Give me your money, and in 5, 10 years' time, maybe I'll return it back to you with a return. Well, that can make anyone very uncomfortable, as you can imagine. If you don't understand what they're going to do with your money, then it's hard for you to justify why you would invest in the first place. So what we're trying to ensure is that they do understand the strategies. And because through that understanding, they are more likely to invest into these fund managers or directly into these opportunities. And we believe we have proof of concept of that. And that is shown in our investment mobilization highlights over the last, since 2021, so about 2 years now, where we have managed to mobilize over $113 million into 3 infrastructure type opportunities. One being student housing, affordable housing, and a road project in northern Kenya. The promoters of these opportunities came looking for under $100 million, about $84 million, but we managed to mobilize over 34% above that to $113 million. Now, I want to highlight 2 things here. Forget the size. Yeah, you might not be impressed by the size. What I want to talk about here is the number of pension schemes that participated in these 3 transactions. 88 different pension schemes, local pension schemes. And if you divide 113 by 88, you would think, oh, it's a small amount. Yes, it is a small amount, but it's a small amount from a lot of pension schemes that were just dipping their toes in the water. And we know human nature. Everyone acts once others have acted. So now that the 1,300 other pension schemes have seen 88 participating, it's easier for the rest to come in and come in larger size. The other thing I want to highlight here is that all 3 of these transactions had something in common, and that is they all used capital market instruments. And that's something that I would like to highlight. It seems like we're talking a lot about third-party funds, a lot about that. And there's a place for that, but there's also a place for direct investment opportunities, specifically where the pension schemes are comfortable with the mechanics of that investment instrument. If it's a bond, it's very simple. It's very simple for our members to understand how a bond works, and then they can invest in that bond. They can sell down the bond if they want to reduce the exposure, or they can buy more in the future. Also, using listed instruments or capital market instruments allows for tradability and liquidity, better price transparency, a lot of the reasons that are helpful to make pension schemes invest more into this alternative space. So this is what we deem our proof of concept. And so now we decided, let's ramp that up. So towards the end of last year, we had a public call for investment proposals where we invited either third-party fund managers or direct promoters to submit projects to us to invest in. These were in infrastructure and general alternative assets. We were sector agnostic in terms of investment location. If it's a direct opportunity, it would need to be local. But if it's a fund, Pan-African is fine. Instrument, if it's direct, we'd be looking at debt. If it's equity, we'd rather invest through managers that have that expertise. And then we're looking at local currency, Kenya shillings. And if we're looking at debt, primarily a minimum yield of where the government bonds are. And that's important because that money is currently sitting at government bonds, like I showed you in the previous slide. So it's going to be very hard to justify selling. Government bonds are at 17, 18% in Kenya right now. It's very hard to justify selling something that's giving you 18% to buy something that's going to give you something lower than that. So let's be realistic here. The minimum rate of return has to be the opportunity cost, which is where the funds are currently sitting, which is government bonds. Now, we received 57 proposals from that call, valued at about $5.5 billion, and you can see the range of sectors. Energy, property, healthcare, affordable housing, agriculture, telecoms and ICT, logistics and transportation, water and sanitation, as well as other. And this other includes elements such as financial services, hospitality, and the likes. This just shows you the wide breadth of opportunities that are available for pension schemes. And they were looking at a mix of both debt and equity. And I mentioned how we would look at either of the two. So what we did is we spent about 6 months screening those 57 opportunities. And in July this year, we had our annual investment conference where we launched the GEPF investment deal book, which had summarized or at least shortlisted from the 57 to about 20 opportunities worth about 2.5 billion. And that is our current pipeline. That's what we are looking at investing today. And so this is just a highlight of those opportunities, just to give you a sense. I took some time when we were sitting down just to convert these numbers into dollars for the sake of the audience. And I won't speak about any specific opportunity. I just talk very broadly. So in general infrastructure, we have about $700 million worth of opportunities that we're looking at. Remember, both direct, so directly into a project, or through a fund. In energy, we have about $225 million worth of opportunities. In property, 150 million. In healthcare, about $500 million worth of opportunities. In MSMEs, about $475 million. And in agriculture, about $250 million. So in total, that comes to about $2.5 billion, depending on where the exchange rate is on any one day. But think about that 2.5 billion in context of what's the size of the industry I told you earlier. That's about 13 billion. So we're looking at, just from our pipeline alone, from really just 6 months of being very determined about this, we have been able to get opportunities that are valued at about 19% of our entire industry. So questions about there are no bankable projects out there, I would like to say there are plenty. The problem is not the regulator. The problem is not the opportunity set. The problem is us. The problem is our understanding. The problem is the recognition of the fact that these investment opportunities can really move the needle of our own portfolios, especially those of us that are small. I had a lot of sympathy for one of the panelists who was here earlier on from the New York pension plans. And he was saying that the smallest check they write is $250 million. Now they have a problem if they're looking to invest in Africa. But for some of our funds that are definitely, $50 million to $500 million, there is more than enough opportunity for us to take advantage of without us worrying about being 50% of the opportunity or 100% of the opportunity. So, I'll close there and just hope that this has given us some understanding or some excitement that should we get our investment policy statements in order, should we now recognize that there's more to be done outside the typical traditional listed space with stocks and bonds, should we start to feel that we are overexposing government bonds and there are all these challenges and concerns about debt sustainability, there are alternatives. And there is a home for our money to the benefit of all our members. So thank you. Thank you very much.
Thanks, Ngatia. Yeah, up next and last and certainly not least is Vuyo.
Yeah, I certainly did get the graveyard shift. Before I start with the presentation, I think probably worth spending a minute introducing who I am and where I come from. So I'm the joint MD of a business called African Infrastructure Investment Managers, better known as AIM. We are the largest and probably the oldest dedicated infrastructure equity manager on the continent, and we're part of the Old Mutual Group. We came out of a joint venture with Macquarie, one of the largest global investors in infrastructure globally. We have a 40-member investment team, and we have 5 offices across the continent. We're a firm believer in boots on the ground. And in our Pan-African asset base, we have 36 assets. We've done 14 exits and currently have a 22-asset portfolio. Our business is largely split into two realms. One is a dollar-denominated Pan-African business, and we're in the 4th iteration of our Pan-African funds at the moment, as well as an open-ended South African fund, a $1 billion fund, open-ended, that's invested across the sectors in South Africa over the last 20 years. More recently, we've also established an emerging markets joint venture with a team that was previously responsible for managing the IFC asset management, and they're in the process of currently raising a global emerging markets fund. So we're a business with some insight into what's happening internationally, which is what I've been asked to speak to today, which is the various trends we're seeing in the international market. So I'm not sure if the slides are going to go up, but before I get into the detail of the slides, I think one thing you'll see from the slides when I get into them is the fact that there's been a significant decrease in fundraising and in the global markets, and this has largely been as a result of what they call the denominator effect. So the rapid fall in equity prices across the globe has led to many pension funds and allocators being above their target allocations in terms of infrastructure and other alternative classes. I think, notwithstanding that, however, infrastructure has proven itself to be a robust investment class and has shown that it's got limited volatility, which is what you'd expect from the class, and has given reasonable returns that one would expect from such an allocation. Globally, there has been a slight bifurcation in the market. So we've seen some managers remain what we call super core managers, and core infrastructure is really investment in kind of highly regulated utilities where there's certainty as to cash flow, whereas the other side of the market is one which we call value add, where value add strategies have really become the vogue, where unfunded pension plans, for instance, are trying to hit funded levels by taking on a bit more risk, and these are kind of funds and strategies that take on a bit more risk. I'll also show that there's still quite a bit of dry powder in this market, and that's largely as a result of record fundraising over the last year. Just moving on to the slides, and I'll move through them quite quickly. The first slide shows what's happened in terms of fundraising over the course of this year. So if you look at fundraising in H1 2023, it's actually only 4% of what global infrastructure raising was in 2022, and that's the denominator effect that I spoke to a bit earlier. I should also mention that 2022 was a record fundraising year with many global managers raising record funds. So the likes of Brookfield raised $24 billion in global infrastructure funds. So from a trajectory perspective, there's been tremendous fundraising in the market, and I think the H1 result this year is as a result of those previous allocations now coming to bear, and a lot of your allocators now being over-allocated to infrastructure. This is a graphic that Sipho showed a bit earlier. I think my focus here is just to show that of the funds that are in market as at the end of July 2023, a lot of those are actually multi-regional rather than region-based. There is a problem with that rest of world number. I mean, some work we've done internally around market, or rather funds that are out in the African market at the moment. I'd put the Africa number at closer to $10 billion at the moment. So it's probably more a function of how infrastructure investor has collated information on those funds that are currently in market. I think some big takeaways on infrastructure as an asset class. I think if you look at the graphics that are currently up, graphic 1 shows that infrastructure is mainstreaming. You'll see that infrastructure allocations among investors, more than 50% of investors have allocations towards infrastructure, and this is quickly closing the gap on investors with private equity allocations. The impact of the denominator effect is seen in the second graphic, which shows that the number of over-allocated investors is increasing, as can be seen from that 2023 number, and it's largely a result of their listed holdings losing value, as happened at the end of last year. One thing that's very important for us in Africa is obviously ESG, but what we've seen when international investors are polled on what their key allocation determinant is to infrastructure, you see that infrastructure, or rather ESG as a factor, is relatively limited, with I think you're looking at about 30% of investors currently saying that ESG is a critical factor when making an infrastructure allocation. It's very different to what we see on the African continent, given the high prevalence of DFIs, who are a very critical allocator in this part of the world. But as can be seen, the driver for infrastructure investment in much of the world is more commercial than ESG driven. The other element of allocations from global investors is that co-investments, i.e. where a fund makes an investment and there's the ability to allocate directly to investors in the fund, is a very key determinant of who allocators allocate to. So allocators such as Sifiso, when they look at funds such as ours, are very keen on having co-investments where they can invest directly themselves. I think a lot of your larger managers, where you've got dedicated teams who can actually follow co-investments, it's a lot of your big allocators internationally have dedicated teams who can follow co-investments. On the continent, unfortunately, as has been mentioned, the expertise in-house within allocators is limited, and the ability to follow co-investments is therefore limited. Speaking to deals and capital, if you look at the first graphic, you'll see that dry powder relative to amounts of money that have been called over the previous period are currently at a record high, and what this has meant is that this dry powder has ensured that valuations of already invested in infrastructure assets across the world remain quite high. I think also interesting is graphic 2, that shows that almost 2 times the amount of committed capital last year expect to close in 2023. And I mentioned that 2022 was a record year. It means that given the denominator effect, I think a whole number of fund managers who are out there raising infrastructure funds are unlikely to raise their target raises because, first of all, investors are largely over-allocated, and there are lots of funds out there in the market at the moment, as could be seen from that graphic I shared previously. Infrastructure deal making is picking up from the COVID period, where we had a lull in 2020. That's picked up again, lots of deal flow in 2021, and I think through the third quarter of 2022 there was still significant deal flow. I think core and core plus infrastructure, again, lower risk regulated deals are still where the big focus is for investors. And from a growth perspective, to close out, I think the sector is still expected to grow globally. I think over the last 5 years, there's been north of 20% in compound annual growth in allocations towards infrastructure. And we expect that this trajectory will maintain. I think the current forecast is 13.5% over the next 5 years. So we expect that allocators are continuing to give more to global infrastructure, and we hope that there's a similar trajectory from allocators on the continent. I mean, to maybe give an example, and there was a discussion earlier about just the extent to which local pension funds are allocated to infrastructure or alternative assets more generally. I think if you look at the South African market, we have a 2% allocation to alternative assets versus 8% in the OECD market. So I think there aren't any regulatory barriers to pension funds allocating more to infrastructure and other alternatives. And we really do laud initiatives such as those run by the big asset owners such as GEPF, EPPF, etc., to crowd in more pension funds to invest in the sector, and hopefully the growth that's been seen in the sector across the world will be reflected locally and on the continent. Yeah, thank you very much.
No, thanks a lot, Vuyo, and thanks to all the panelists. I know it's a lot to take in, but as an overview, you'll note that we started the discussion on the key growth areas and why infrastructure is a strong investment case for the continent. We then moved the discussion towards pension funds and why pension funds should consider investing in infrastructure. We then zoomed out from a regional perspective to look at how things have worked in the continent. We also then touched on some mechanisms from a pooling perspective that some funds are considering. And then lastly, again, we then had a consideration from a global perspective on infrastructure trends and how they may impact the continent. So with that framing in mind, I'll then basically have a discussion with the panels, with the panelists, and then also then invite for comments and questions at the end. So I'll start with Sipho. And the question that I have for Sipho is that with the vast need for investment in infrastructure and maybe, dare I say, a negative picture that we have, do you see any green shoots? And is the Africa Free Trade Agreement one of those green shoots that you see and anticipate?
Maybe let me answer your question with the following. Certainly, in this gloomy picture that I tried to present, there's tons of opportunity, right? I think one, it's Africans themselves are doing it for themselves. We're not going to wait for the world, and we are not waiting for the world, right? Because these are our lived experiences, and certainly as Africans, we know that there is better that we can get, right? So I think it's quite important from a mindset point of view that we're also clear about that. And I think I want to say this in the context of the mix that is in this room, so that, certainly the non-African based people who are here don't live with a sense of condemnation. There's no condemnation, right? The work that AFTA is doing is extremely important. There is more that is actually being pronounced now that you've seen the experience coming out of COVID, right? So nearshoring and onshoring is certainly something that has put a lot of spotlight to how us as a continent, one, do not have to relive the nightmares that the world and the continent itself has gone through with what COVID presented us, right? You can't continue, to be beholden to what happens elsewhere before you get the help that you need to absorb those shocks, right? We also, for instance, with medication for COVID and whatever else what was happening then, we can't be last in line, right? So providing infrastructure as the backrock to what our growth means that we need to be quite clear with ensuring that we debottleneck the problems that have limited growth, and part of those problems are, as I highlighted, really talk to the inabilities of why we don't trade with each other, right? So unlocking intra-trade certainly then makes the continent actually quite compelling as a value case, right? The continent's trade totally as an addressable market, certainly from an AFTA point of view, has been put at $3 trillion, right? A lot of that $3 trillion harnessed properly and unlocking the opportunity set as we have it is something that, with all of us put together, investing in infrastructure and unlocking those bottlenecks, we can then, have the inducement that will grow the pie even bigger. So yeah, put simply, the other set of that question is in the opportunity, as I put it, that is presented by climate change, right? What climate change has done is certainly put a lot of focus on infrastructure as a solution to a lot of the problems that we have. How we invest going forward is addressing those very needs. So it's put really, the downside of climate change are there for everybody to see, but it's put Africa certainly at the center of answering these questions. And the other thing that, to close off, so without being long, is where are those green shoots? I've presented the roads is massive. There's a lot of cash that's coming in for renewables, and it should continue, but renewables alone for the continent aren't going to solve all our problems, right? We need to have massive conversations around base load and how we get the center right on that sense, and I think those conversations are ongoing, but maybe we won't have time enough for that.
Well, thank you for that response. Maybe I'll bring Leslie into the discussion. In the arguments that you presented or threw at us, as you put it, one of the constraints that you put was skills and risk appetite. Maybe our question to you, or my question, is that do you view this as insurmountable? The risk appetite and the skills to look at infrastructure opportunities, and what do you think? The industry, particularly industry bodies, investment consultants and the likes, how can they assist in that perspective?
Thank you, Sfiso. I think the biggest challenge around infrastructure is lack of knowledge on the part of the decision makers. The skill set exists. Let me give you an example that I think will help me to explain the point. If we look in banking and finance, the concept of information asymmetry has caused the banks not to lend to SMMEs. I have read a research that said there was a credit guarantee scheme that was put together, and the banks were given those guarantees to lend to SMEs. There was less than 2% of defaults. But in the normal course of banking, those companies that are considered to have all those things that you may think of, collateral, strong financials, they're defaulting. But because of information asymmetry, the way that the banks assesses SMEs is from that lens. So if I bring that to the boardroom, the fact that the trustees around the table don't understand what happens on the other side, the concept of information asymmetry comes into question. It is too risky. But if you were to say, let's unpack this risk, no one is going to put it on the table. as you indicated, Sifiso, I've advanced the case for infrastructure investment, right? From a micro point of view, from a macro point of view. On those bases, there must be a change of mindset, a change of thinking. One argument that's always thrown around is around returns. And I've demonstrated it with numbers, given what the investment returns over the last 5 years, right? Obviously, you can't predict the returns going forward. But there is evidence. So we also need the consultants, investment consultants, to support us. But we also need the trustees around the boardroom tables to get capacitated, get knowledge around those issues. But more so, and I've noticed that it's starting to happen within the South African context. You now have the principal officers and the executives of pension funds being in their own rights technocrats. So you are able to advise and guide the boards around rationality of some of these things.
No, thank you for that. So the point that is made here is one of, basically, as you say, information asymmetry. Thabo, maybe if I could ask you, you made mention of, the pooling instrument that you are currently thinking about at EPPF. So a question that comes to mind is, there's a tension here in the sense that to develop things at scale, particularly in infrastructure development, you have to aggregate and pool, right? So the argument then, or the dilemma is that you'll have members of pension funds who will seek development in their area or locality. But in order to have development at scale, things have to be centralized and development will happen elsewhere. So maybe if you could give us your thoughts about how you think about that dilemma.
Sure, thanks. Yeah, we certainly grapple with that locality and centralization tension within our fund. We've got about 75,000 members across the country, and they often come to us and say, can we develop solutions that really speak to their, as you say, specific locale? And so definitely an issue for us. And I'd say in the past, we really haven't addressed that directly. Private markets investments make up about, let's say, about 8% of our 180, 190 billion rand fund. So a reasonable amount, but really still growing. And really a lot of that execution has been through other fund managers. And so not really anything direct from ourselves. But with an eye on the future, as we grapple with this question, we're trying to develop solutions, this one potentially included, that really does talk to how do we address the needs of someone based in Mpumalanga who says, look, we want you as EPPF to invest in infrastructure in my specific location. As I said, something that in the past we haven't done, but really something that we think as we develop ourselves, as we develop solutions, as I said, this one included, we'll try to address. And so that's really the journey of the EPPF to date.
No, thanks for that. Yeah, so it is a very tough question because, yeah, I said there is, a tension there. So maybe if we could bring Ngatia in the discussion. So firstly, I'd like to commend what GEPF has been able to achieve. I think the stat that you mentioned was, I think 18% odd of the pension fund industry from an asset point of view has started or it's found its way into alternatives, which I think it's highly commendable, especially when you consider the stat that Vuyo mentioned, around 2%, maybe in our jurisdiction, thereabouts. My question is, when looking at the presentation, what struck out was the 75% into fixed income. And yeah, you also did mention that, you've got at least like 19% from a yield point of view. But is there something else besides, that's such a significant allocation into fixed income in your region? And how, do you then make the argument to have that move to alternatives, especially with the success that you've experienced?
So yes, thank you for that question. Just to correct something, 18% is the size of our current pipeline. And we're not saying by any means that we're going to invest, we're going to fully fund that pipeline, but it was more a reflection that even just on our own pipeline over the last year or so, having a target of 5% of our assets as an industry into infrastructure is very, very possible. But the real number, what has been invested, is under 1%. Like I mentioned, I wasn't joking, it's actually 0.2%, right? So there's certainly a lot of space that we can fill and we can invest in. Why is fixed income so popular? It's really simple. 3 main things. The first is there's the understanding of how fixed income instruments work, right? We understand cash flows, we understand credit risk, and it's not a novel or a new or exotic type of instrument. The second is the pricing. So especially when you're looking at government bonds that are now returning that 17, 18, and I know we're headed north of that as well, it becomes a very easy decision or a very easy strategy to simply say all new funding, all new capital contributions just simply go towards that asset class, especially considering that equities have been tanking. So it's a no-brainer, right? And the third is liquidity. Yeah, so you can say liquidity, or you might use the word tradability. These pension schemes want the ability or value the ability to trade in and out, of positions. And that's where I think we've found a lot of private equity type opportunities, not really tick that box, where you're essentially locking in these capital commitments for years. And the challenge with that is that you have trustees that are on a 3-year cycle. And many of them, they have understood that as trustees, they have the fiduciary duty, so they're ultra conservative. And so they're not going to be very keen on getting into something that they're not sure how they will get out. And we hear all about, trade sales and the likes and, different ways of getting out. But, in practice, it really requires you to have a leap of faith. It really requires a leap of faith. And, we're in a low trust environment in general. And so that kind of leap of faith is very hard to bank on. But, this is where using, not reinventing the wheel is so critical. Yeah. So use those same elements of a fixed income instrument, but now use those to channel funding into alternatives or into infrastructure. And that's why I really like the idea of the ESCOM listed fund, for example, or listed vehicle, right? Because it will be listed, we will be allowed to invest as much as we want today and divest as much as we want tomorrow. It will be, I'm sure now that it's listed, there will be trading transparency as well. And so these types of structures are really important. But now, as much as we are, and I did show we are 75% allocated into fixed income, that has not come without its fair share of nightmares. In the past, the pension schemes, we all believed that buying government bonds is risk-free, right? And now we have seen that it certainly isn't. You have interest rate risk with interest rates going up, the value of those bonds are going down. And you also have now credit risk concerns that it's not just Ghana that can have debt distress. Yeah, so we have had those same concerns about Kenya. So that is certainly a tailwind, or something in our favor as we're looking to diversify. But unless these new products do have some of these features that are fixed income-like, yeah, it's going to be a challenge.
No, thanks for that. Maybe I'll pivot slightly and invite the audience for questions and comments if there are any. At this stage. Okay. While everyone's getting warmed up, or thinking about lunch,
Hi there. Sviso, just a question maybe for Thabo. Thabo, just with regards to the vehicle that you spoke about, do you envisage a stage perhaps where you do get banks online to sort of come to the party and help grow that fund and market it more broadly, or do you see it still staying more on the pension fund side and getting partners on your side to help?
Thanks. The role of banks. Interesting question. We've, with respect to banks, have been thinking about potentially using them for some insurance. And so quite attractive kind of in this space has been banks providing political risk insurance. I think about the likes of large banks, JP Morgan, for example, and other big banks providing that insurance, just to give our members, just give investors some comfort that perspective is covered. I say that with the lens of thinking about the fact that when we think about our investor base, we're not only actually pitching this to local asset owners, even though that really is the focus up front. We are thinking beyond that. We are thinking, let's maybe talk to asset owners offshore. And that obviously come in with really two big issues. One, political instability and having to cover that, and the second one being currency potentially, again, another place where banks would come in and help. So really those are the two main areas that I can think of right now. In terms of your question around marketing it broadly, yes, we're open to it. As I said, early days yet, and so that conversation is one we're happy to have with banks. In fact, we have had with banks in terms of form and structure. And we started out thinking maybe an MC is the right answer for this particular vehicle. Can't really say too much more than the fact that in our minds we thought it really wouldn't work out when we factored in Regulation 28, and really with this kind of small pension funds in mind, them being able to blow past their bank allocation as opposed to, in that Reg 28 framework. And so quite a bit of thinking has been done. Again, we'll continue to collaborate with banks. Should the need rise.
Sure, thanks for that. Maybe if I could maybe bring you in. You mentioned that I think over the past 5 years, you've got at least 20.5 growth, and you anticipate at least 13 looking forward. And with that graphic of not a lot of that global expected growth finds its way to the continent. Do you have thoughts on how Africa, from a deal activity point of view, can increase allocations, from a fund manager perspective? Do you have thoughts on that?
Yeah, it's a tough one. I mean, the age-old problem, which people mention, and you mentioned in your presentation, Gatia, is around deal flow. The fact that projects that are bankable, to some extent, do not match the amount of capital that's available. I think what we have done is, from our perspective, is almost a pivot from a project focus to a more growth platform focus. Thank you. To a more growth platform focus where the ability of companies to almost seed underlying projects and scale themselves is that much more increased than what we've had in the past was almost single project focuses where you'd wait for government processes to yield projects. But we've really, over the last couple of years, have had to reprioritize where our deal flow is coming from, set up platforms that are first of all, seeded with assets that can pay for the management teams that are put in there. Those management teams then, on the back of that, look to go out there and develop, let's call it commercial infrastructure. So I think the answer to Africa's infrastructure shortfalls, unfortunately, is not going to come from large government processes. The experience over the last decade has been that in many instances, governments don't pay when they've got obligations on large infrastructure projects. And that's rattled us, and we've kind of reoriented ourselves to being the providers of commercial and industrial infrastructure. And there are a couple of verticals where that works. So digital infrastructure is one, where you don't have too much government interference. Mobile networks requiring towers, data centers, and fiber to the home and fiber to the office. Imminently scalable, doesn't require too much government interference or government programs as long as the underlying regulation is in place. Similarly, logistics is another area we've identified, and we've gone quite big into the cold storage space, for instance, in recognition that the big macro trends that will drive scalable infrastructure development on the continent are around urbanization, the need for food security, etc. Again, no need for large government-driven projects or government credit underpins. You can do so as a private sector player. It's scalable, and on the back of that, it's then possible to go raise large amounts of capital from both private DFIs and other investors to help alleviate this infrastructure problem on the continent. And yeah, we're sort of, to some extent, it's unfortunate. We have to, I think South Africa is probably the exception to the rule, where the large government projects are still working. But in much of the continent, it's very much a private sector-led infrastructure growth initiative where, because of the needs, and the fact that you're able to almost pull up your socks and go and establish this infrastructure on a private sector or business-to-business basis, you can actually grow out a large infrastructure platform.
No, thanks for that. I don't think we have any further questions. So I think with that, we can close the session, especially in the interest of time. Thank you to the panelists, and thanks for listening to us. Sure.
You even caught me off guard. Even I wasn't ready for that. Thank you so much to you, gentlemen, and thank you for spending the time to focus on the issue of infrastructure investing. Ladies and gents, we're going to keep it moving. If you do need to, take care of nature calls, you feel free to. But we are going to move on to our next panel, which will be looking at the pension policy and regulatory reforms. And as I call the panel, please make your way to the stage. The moderator is the head of retirements at Alex Forbes. That's Avishal Seeth. Please make your way, Avishal. And Avishal will be joined by Zarina Kamrudian, who is a department head for trustee conduct and governance for the Financial Sector Conduct Authority. That's the FSCA, as you know. And also Brian Karitsa, who's head of Actuary and Benefit Administration Services at the GEPF. Jonathan Maud, who's the director at Jonathan Maud Incorporated Pension Fund Attorneys. Himasni Jain, who's the senior social protection specialist at the World Bank, as well as John Chilman, the chief executive of Railpen UK, and also the chairperson of the policy board of the Pensions and Lifetime Savings Association. Avishal, over to you, sir.
Afternoon, everybody. Thanks so much for that, Andile. I can see you getting a bit agitated. I see a bottle of Vinde Constance in your future. For our American counterparts, it's only $70 a bottle. Please buy one for Andile. What I'm going to do quickly, ladies and gentlemen, is that we've got quite a broad range of topics that we want to cover. But I thought I'll just set the scene for you very quickly. through a couple of slides. You can see we've got an esteemed panel that's going to help us from an international and local perspective as well, cover some of these topics. A lot of the stuff we're going to talk about has already been spoken about in some detail, so we're going to keep it on kind of the legislative policy and reform side and try and hopefully get some insight as to how the rest of the world has experienced the changes that we also currently undergoing, and also come to a realization maybe that we are actually well ahead of some of our peers globally, and also in line with some of our peers globally, which is great to find out. So the first thing is sustainability. Sustainability, massive focus on sustainability at the moment, locally and globally. One of the things for me is, I've got 25, 30 years to retirement, Jonathan. So I want to retire into a world that's worth living in, right? So you want to make sure that the infrastructure is there, that we alleviate poverty, that we do all of those things related to those goals, and sustainability is critical. And the value of actually incorporating ESG into decision making is there for everybody to see, and many of our speakers have focused on this. I'm not going to touch on this, but there's lots of evidence of correlation between incorporating ESG and actual performance, right? In South Africa specifically, retirement fund savings represent a material proportion of GDP. So over 80%. We own 40% of the assets on the JSE. There's more than 5 trillion in assets in the retirement fund system. But the success of a retirement fund is critical. And we know the 6% number, that only 6% of our total membership base can expect a replacement ratio in excess of 75%. So the 6% number has been thrown around for many years, and I think we're all very tired of hearing that 6% number. If we look globally where South African pension funds rank, there's one South African fund on this list of the top 100 largest pension funds, and that's our very own GEPF. So well done to our GEPF at number 32. So punching above our weight again, that's actually massive. Very well done to the GEPF. As usual, we do punch above our weight. But we do face challenges, right? And these are the challenges that we faced over the recent past, from the pandemic to natural disasters that are continuing, increased market volatility, increased inflation globally and locally. And now the prospect of another world war, maybe facilitated by us. Where's my American delegates in the room? All of these things are happening, and we're experiencing it, and it does have an effect on the way that we conduct ourselves. And then, Zarina, there's massive complexity in the retirement landscape, right? So we've got over 100 pieces of legislative and regulatory changes in 2022, and we expect this to increase for several years. Lots of different retirement funds. We're looking for flexibility for members to meet diverse member needs, and legislative and regulatory frameworks are increasing in demand for boards of trustees to basically comply with all of this. Just a bit of a timeline for everybody, and especially for our foreign delegates. We started off, like everybody else, with a focus on defined benefit funds, and you can see that in the 50s, defined benefit funds dominated in South Africa. Move over to the 90s, that's when the shift started from defined benefit to defined contribution funds. And today, the majority of the funds in South Africa are DC funds, obviously. In the 2000s, massive shift from privately administered or standalone funds into the umbrella fund environment. And that shift has continued, and it's accelerated, and the pandemic actually accelerated the shift even further. Employee well-being and individualization, focusing on the member, has become one of the biggest focuses in the retirement fund industry. And the research we've done shows that 82% of the stakeholders that we interviewed said that individualization of the members' experience of retirement funding is the biggest opportunity that we have to make an impact on people's lives by educating, informing, and engaging them to make better financial choices. This does result in a bit of a conflict between the institutional and individual constructs, right? But the regulation is taking us towards this individualization direction. The use of technology is going to become more and more prevalent, and we're going to use this to empower members and engage with members a lot better than we have in the past. That said, our experience is poor retirement outcomes in the South African environment. If we have a look at our active membership now, we project on average a 40% replacement ratio. The average actual replacement ratio is around 30%, but these are value-based measures. We know that the lived experience of most members is that they need to manage with less than 20% replacement ratio, and that's the reality in South Africa, right? I spoke about regulatory trajectory and the alignment with retail. It started back in 2004 with reform. Default regulations came in 2017. Kudos to the funds that implemented prior to 2017. Retirement benefit counseling, again, this one-on-one engagement with members became very, very important. COFI, also something big that seems, we seem to kind of ignore it a bit because of two-pot, but COFI is as big. T-Day came into place in 2021, and then two-pot, obviously, on the cards for 1 March 2024. So, there's a few big themes that we're going to focus on today. The first one is consolidation. So, good afternoon to my esteemed panel. It's good to have all of you here. So, consolidation, I spoke about individualization, two-pot, linked to sustainability, which is another big theme that we speak about, and financial inclusion, obviously. So, these are the 5 kind of themes, broad themes that we're going to focus on. I actually want to start with our representative from the World Bank, and I'm really, really interested to get some thoughts from you, Himanshi. So, how do you see the landscape of pensions in South Africa, including our risks and opportunities, given your work in multiple countries? And are our challenges unique? Because it's very easy for us to become inwardly focused, right?
Thanks a lot for this question. I hope you can hear me okay. As you could see from my title, I'm a social protection specialist, and relative to a lot of people here who look at it from an investment standpoint, deepening financial market standpoint, the way we look at it in social protection is pensions is part of the social protection programs and services that are essentially there to help build resilience of individuals across the life cycle. So we really see pensions as part of what is otherwise a cradle-to-grave policies that will help people across their trajectory of building human capital. At the core of why pension systems are created, there are sort of 3 key objectives. First is their systems don't want people to be in poverty at old age. So poverty protection is one core objective. The second is consumption smoothing. So save when you are in your working age for the time when you're not going to be working, so retirement time. And the third is longevity insurance, which is another way of saying, people don't know how long they might live, so you need to have insurance for that period of excess mortality, and the risk pooling aspect comes there. So now let's look at how South Africa's pension landscape fares against those 3 objectives. Your old age grant, that actually ticks off the box on both the poverty protection and longevity insurance. And if you look at the numbers, approximately 73% of people above the age of 60 in South Africa currently get the old age grant, which is actually a means-tested benefit. It's not a universal benefit. But the beneficiary coverage numbers are still very high relative to other countries in the region. Because the beneficiary coverage is high, and because the average benefit is also more than the poverty line, it's approximately 3 to 4 times more than the minimum poverty line, this costs money to the treasury, right? And it's actually one of the more generous schemes. But because you have this scheme, you're able to check the box on those 2 objectives, which many other countries are struggling with. Now let's look at the consumption smoothing piece, and this is where the legislation sort of aims to address this by looking at this 2-pot structure. In a lot of other countries, how they address it is essentially by mandating, and we heard from Sebastian, you need to mandate both contribution and in some ways also restrict withdrawals to ensure that consumption smoothing function comes into play. So now that's the landscape of South African pension system. But then let's look at the challenges that's facing pension systems globally. And sadly, South Africa is not immune to those challenges either. And Avishal mentioned a lot of them in his PPT, so I won't repeat. But there are 3 things which I would like to add to that. First is longer life expectancies. And a common mistake people make is when talking about pension systems, what you're interested in is looking at life expectancy at retirement age. And that's actually much higher. People who make it to 55 or 60, on average in South Africa, live for 18 years. So you can imagine the maths of this is you have to think about how much you need to save so that that money lasts you for 18 years, and it can be quite substantial. And this is why, unless those expectations are managed, you get into these issues of low replacement rates. The second challenge is the changing nature of work. We're no longer in those times where people are going to stick to one job and there's high levels of labor mobility. People are in and out of work, in and out of formal, informal. Labor markets are much more diverse and fluid. So this payroll financed model, which has got in Europe and OECD countries a high level of contributor coverage, is essentially not working in a lot of the emerging markets and developing economies. So there's really a need to rethink that approach and whether payroll financed model works. And I'm happy to come back to sort of other experiences. And the third thing is just the sheer fact that the prevalence and incidence of shocks is ever increasing. And there's not enough protection for short-term risks. And that's where you need to adopt a social protection view and not just only look at pensions separate from these other risks. So just to summarize, there's great work already done in South Africa, but among the things to focus on in the next discussions is going to be coverage, compliance. How do you make people to pay when they already know they have this social pension waiting for them at age 60? Contribution density, the fact that people pay regularly so they have enough for retirement.
Thanks so much for that, Himanshi. You really took us back to basics, and we aren't alone in this. We actually aren't alone in this. So shared experiences across the globe. John, I want to come to you. South Africa often follows the UK from a legislative perspective. If we think about retail distribution review as an example, if we think about what we're calling two-pot, which is our early access, I think you've got a sidecar kind of terminology that you have in the UK. So there is what seems to be a very old picture of me in the notebook. It's actually not an old picture. It's a picture of me the day before our two-pot legislation came out, which was a couple of months ago. And you can see how stressed I am because of this. But John, could you first give me your experience of the level of individualization and the push towards individualization in the UK from a member experience perspective? I know that the retail distribution review in the UK actually, in some cases, banned commissions, as an example. Could you just give us some perspective on that?
Yes, happy to. I think that the best thing to say is that when you look at the UK market, it's still largely employer-based pension plans, and that's what I represent on the PLSA. When I speak to government and regulators, I'm talking about 30 trillion rand of investments behind it. So it's a very big deal. There are individual pensions, and increasingly the UK is probably a little bit behind South Africa in moving towards DC as their prime way of providing for pensions. But we saw a move about 10 years ago into auto-enrollment, which has rapidly increased the number of people who are saving regularly into pensions. It still disenfranchises some, though, so I wouldn't say it's everybody, but we've got about 85% of those eligible in there at the moment. But that was a great tool, but it has changed the dynamic for us. Historically, we've been heavily DB, which is all collectivized, it's all very clear, it's done for you, the saving level is set, the benefit level is set to provide you with the right degree of cover, and then suddenly we're in something which has fundamentally changed, and that has been very difficult. The UK has struggled to engage, other than defaulting people into a set contribution rate and a set investment strategy. People have choices, but they don't really take them at the moment, and that sort of moving down the line is really difficult. As far as the two pots goes, yes, we are talking about sidecar. We don't have any option of taking money out of your pension plan at the moment, and even sidecar, and I'll talk about what that is in a second, doesn't allow you to take it out of your pension plan. I've worked in the US extensively as well, where you do see this early access. The danger is the money never goes back in. All you're doing is reducing the amount of income you have in retirement. So for a lot of people, it's a bad thing to do. But when you have that need through illness or other issues and your house is going to be repossessed or whatever happens, I can understand the need to do it. So sidecar is a new initiative that's being put forward, not to take money out of pension, but to say when you're saving into pension, actually we create a buffer zone. We put maybe 6 months worth of contributions into this account, and then basically all future contributions cycle through it. So we keep that 6-month buffer, and then after 6 months, money starts going into your pension. So if you need things, and it was particularly important. I used to work in the bus industry. It's quite a low-paid industry. People didn't have savings. I introduced the use of credit, forced, almost mandated credit union membership. So people started putting money in to have small savings for even things like replacing the washing machine or things like that. Things that were fairly basic to how do I sort of get to my job, do my job, and all those sort of things. So it's a really difficult environment. Collectivism is great, but increasingly the model is going to move towards individual type structures. But we don't have that many people now that take advantage of actually physically just going out and making their own personal pension arrangements, which is the ultimate position. When you get free money from your employer, you should take it.
Absolutely, that's definitely a theme in South Africa as well, John. Just a quick follow-up. In your experience, is 4 months enough time to implement the biggest fundamental change in pension policy in a country? Which is what we're looking at in South Africa.
There's a very short answer to that, which is no. I mean, we're looking at things like pension dashboards in the UK, so that we can actually, people can see their pensions from from different places, recognizing that people do move around regularly, and it's actually important to know what your total pension provision is, not what just comes from your current employer. It sounds very aggressive. The problem is getting these things wrong is very, very dangerous for the member, the employers, and for the whole pension community, because pensions are built on trust. If that trust is lost through this, we're in a really dark place.
Thanks so much for that, John. Jonathan, let's spice things up a bit. I know that you came here with the sole purpose of being a bit controversial. So I spoke about consolidation in the industry, and I spoke about commercial umbrella funds. And the commercial umbrella funds genuinely have highlighted individualization as a benefit of the system, right? But there are concerns around these commercial umbrella funds. One of those concerns is the necessity of member representation on the boards of commercial umbrella funds. What are your thoughts?
Thanks. I think there are two major problems, two elephants in the room, as it were, at the moment in our retirement fund industry from the aspect of governance. The one is the lack of real skills, and I'm not talking about the people who have been presenting here, who really do demonstrate that. I'm talking about it at a different level. The other one, which is one that I think nobody wants to think about or talk about, are the conflicts of interest of trustees, and how you can have trustees on a board that where they say they're wearing a trustee hat, but actually they're employees of the sponsor, which has a commercial proposition around this. So, I mean, the issue of member representation is very interesting, because when it was introduced in 1998, probably around 70 or 80% of the funds, at the top 100 funds at the time, they would have been affected by that, would have had to have employee representation in terms of Section 7A. But now, if you look at the top 100, I think there are very, very few. And that includes the great number of retail funds we've got, but also many of the funds actually get by with just having a single independent and then having indirect representation by members on the board. And that's not really what was actually envisaged at that time. And you know, some of these really big funds, I mean, Eskom, I believe, is one, the EPF, they're able to do this. And there isn't really a reason why you shouldn't have it. But it does, that then brings us back to the issue of expertise, because very often those trustees are not elected on the, because of their expertise. They're elected possibly for other reasons. And we can talk about this later, but whether the trustee toolkit actually remedies the chronic information and expertise asymmetry between boards of trustees and their advisors.
Thanks so much. Thank you, Jonathan. I'm definitely going to come back there, so be ready for that one. Serena, so I've watched you the past couple of days telling everybody from the GEPF that you're going to be regulating them in the future, and you're looking forward to it. So a couple of questions. Can you just expand on what you mean by that, in that you will be regulating the GEPF going forward? And then the second thing is around this regulation and all this regulation that seems to be, hitting us on an almost daily basis. 100 pieces last year, that's going to continue into the future. Is it necessary? Is it window dressing? Are we regulating for regulation's sake? Or is the more important thing actual enforcement of the regulation?
Thanks for, is it on? Hello? Oh, thank you. And I don't know if it's still morning, but good morning. If it's not, good afternoon. And I know Khomotso said that he wishes that he could start at 12. I must tell Khomotso, this is the graveyard shift, so I don't know who should be more envied, you or us. But be that as it may, and just to put to put it on record, I haven't been going around telling people I'm going to be regulating, or we'll be regulating the GEPF. But of course, that is going to happen with the COFI bill, Conduct of Financial Institutions bill for our colleagues from overseas who may not be familiar with it. So once that is enacted, together with the Pension Funds Act, the consequential amendments to the Pension Funds Act, which will form part of the COFI Act once enacted, we will be regulating the GEPF, and it will fall under our remit. So, Avishal, coming to your second question, are we just, bringing in all these changes for the sake of just seemingly being an active or activist regulator? So certainly not. I think many of the changes, it's been a necessary response, if I can call it that. And I really liked what Musa said, and it wasn't at this particular conference, it was at the IRFA conference. But, as Africans, we need African solutions. So, for example, going back to the two-pot system. So I know our colleague from the UK, which we often follow, as you correctly pointed out, is, raised concerns about the access. But of course, as South Africans, we know, and this has happened even before COVID. I think the COVID pandemic just basically, made it more pronounced, the issues that members were facing in terms of not being able to cover basics and losing their homes because of it. And then it became questions of, we need a bit of access. But of course, any crisis, we shouldn't let a good crisis go to waste, as the saying goes. So we coupled that, or I should say Treasury coupled that with, and which we supported, by the way, as FSCA, with compulsory preservation. So Avishal, in as much as access will be allowed, and ASSA, which is our Actuarial Society of South Africa, they've done the modeling on this, it is actually, in the long term, going to have much better outcomes for members, because in fact, I think what the research has shown, or the modeling has shown rather, is that it's going to be 3 times more, that members will basically be able to live on than is currently the case. So it's been part of our, if I could say, our preservation journey. As you pointed out, we had various things. We had the annuitization of provident funds, then we had the default regs, and I see this as another cog in that journey, or golden thread in that journey. So I think it's been seriously considered. All role players have, been involved. It's been part of our NEDLAC process, which means business, labor, government, community has all been involved and had a say in it. And to be perfectly honest, and maybe to go to John's point, is that Labour I don't think would have gone for this if we didn't allow access. So it was also quite strategic. I'm not sure who is here from Labour. Mr. Mashalango might be asking me questions soon. But yes, so Avishal, I don't know if that covers you in some respects, or do you want me to touch on auto-enrollment and other issues as well?
I think we covered for the moment. I'm going to give you a break. But be prepared, there's more.
Sorry, but can I just touch
Sure,
on one
yeah.
other thing? So I know that you've said, or you've asked John, but I think it was a side eye, it's the way my dog gives me a side eye sometimes, might have been aimed at me or us. And you were saying, is 4 months sufficient for, to implement one of the biggest changes? But just to be clear, and also again for the benefit of our colleagues from overseas, for example, so this reform was actually supposed to come into effect last year already, right? Or this year, sorry. And this year. It has actually, given the concerns raised by industry, it has been postponed. I know that there are still concerns, and I'm not negating that or trivializing it, but also, as I said, we must be cognizant that there are also political issues at play. So if we were to wait too long, one is also concerned about losing the opportunity, which I do think, and I think industry's with us on this as well as labor, we've got everyone on board. We don't want this to be a missed opportunity because we delay it for too long. Whether it should be a short delay, that's for Treasury to consider, but I would just caution against, an inordinate delay. Thanks, Avishal.
Thanks, Serena. I agree with you 100%. Look, it is fully supported from industry. So industry has put their support behind this. There are a couple of concerns that we're waiting for responses around, but it's great for the future of the retirement system in South Africa. And I think that's the big picture around this. Short-term pain, definitely short-term pain, because there's member expectation that's been created. There's members that expect to be able to withdraw, but they don't qualify for any withdrawals. There's those kinds of things that we're going to have to deal with. But again, it's short-term gain for definitely long-term gain. The biggest issue in our system is the level of non-preservation, right? And compulsory preservation will definitely get us a long way on the right track in respect of a good retirement system in South Africa. Brian, I know that you're really looking forward to Zarina being your new boss going forward and being regulated by her in the future. And you've got a job that everybody in this room wants, heading up the actuarial and administration of the largest administrator in the country, holding all of the money or a good proportion of the retirement savings in the South African context. From a defined benefit perspective, all right, and we're talking about two-pot now, and I just want to continue on that theme. From a defined benefit perspective, are you comfortable with the way the legislation is written? Is it clear enough for you to proceed as GEPF into the future, or do you have maybe some thoughts as to how it could be improved?
Thank you, Avishal. And maybe before I start, for anyone who's eyeing this job, just a warning, you'll lose your eye. But on a more serious note, maybe before I touch directly on your question, is to understand why two-pot is important and why we as the GPF can welcome it. So I know two-pot is trying to address an industry problem, which was not necessarily a GPF problem, because we didn't have, if we looked at our statistics in terms of resignations, it was less than 2% who were resigning. So it was not exactly a GPF problem, but more of an industry problem. But we are aware that our members do face challenges. Now, moving on to your specific question, the initial proposed wording in the legislation was specific to defined contribution funds. And maybe just to provide clarity on that, when you consider defined benefit funds, what you earn as a benefit is not directly linked to what you're contributing. And in our initial comments to Treasury and to the policymakers, we noted that, and we do welcome the improved wording, even though it doesn't fully address what we have requested, it does provide us with scope. So within a defined benefit fund, whatever changes we're going to make has to reference the service of a member, because that is how our benefits are defined. So we're still waiting for clarity on whether this can be a fund decision that we include in our rules, or whether it's going to be included in the Revenue Laws Amendment Bill itself. But yes, we are comfortable with what has been proposed, and we do have further suggestions on how it can be specific to the GPF.
Brian, 2% turnover rate sounds like a great place to work. So anybody that's looking for opportunities, speak to Brian post the session.
Don't forget the loss of sight.
Noted. Himanshi, coming back to you, what have you seen globally regarding early access and compulsory savings? Kind of solutions for pre-retirement liquidity alongside pension adequacy.
Mm-hmm. So this is a great question, and it's a tricky balance to strike, right? And a lot of countries struggle with this, especially in this environment where labor market is so fluid, shocks are just more common, and you want to be competitive in global markets. You don't want to impose sort of a high contribution rate, which is sort of a tax on labor. So a lot of countries are looking at this question and they're saying, you know, we need to incorporate some sort of early access. And, you know, there are really 4 types of things that countries have done. First, some countries, very few of them, will allow permanent withdrawals. They're often taxed at high rates. And they're only given in cases of acute emergencies, health emergencies, and so on. The second is, you know, Switzerland does it, and some funds in Australia do this as a loan and repayment model, where you can borrow from your pension fund, but then you have to repay it. The third thing is, you know, some countries will use their pension funds as a collateral. And I recall some occupational funds in South Africa do that as well. And the fourth one is, you know, broadly speaking, you can call it the hybrid savings model, which is a little bit of access, but with some preservation. So this is where sort of we are seeing the landscape emerging. Now, to give you some numbers, when COVID hit, the World Bank, we looked at what countries did in terms of into their pension systems. And there were about 68 countries which tweaked their pension system in response to COVID, but only 7 of them allowed early access. 31 of them said, we're going to waive your contributions, give you a temporary break from paying contributions to your pension scheme, but we're not necessarily allowing early withdrawals. And I think this is coming from this place of understanding after the 2008 crisis, is that, you know, pension adequacy is starting to get really hurt if you start allowing people to withdraw. And countries are starting to have this conversation on, are there better ways to protect individuals? So, for example, in the Pacific Islands, there was a research done which said, instead of, say, allowing early access from pension pots, maybe use conditional cash transfers to provide this temporary relief to people in terms of shocks. And here I come back to my first point, is the role of policy is to make sure you have social protection instruments that can come to rescue depending on what the situation is. You know, this idea that the pension system becomes the fallback of everything that is wrong with the labor market, the credit market, then you won't have a pension system left at all. So I think that sort of message is important. One of the things that we're doing to help countries is, I was recently in Vietnam, where this is again a big issue. A lot of people are taking lump sum withdrawals. So we try to understand why these people are taking, who are these people who are taking it. And interestingly there, it's largely young females who are taking up these withdrawals. And the reason they're taking is because childcare is extremely expensive. So, you know, a lot of times people do take it because they're very acute human capital needs. And to try and understand why that's happening in your particular country context, and are there better ways to address it? Because quite frankly, you know, getting a little bit out of that money is not going to save you in an emergency. So it doesn't serve any goal at this point in time. So, you know, the better way to approach it is try and understand where the gaps are, why is it that they need those early access, and see if there's other ways to address it.
Thank you so much, Miwanchi. Appreciate that. Jonathan, back to you. You've represented pension funds, you've represented the regulator, you've represented various bodies. So, you know, I want to go back to conflicts, speaking about conflicts. In this rapidly growing umbrella fund environment again, how do we guard against these sponsor conflicts? Because you'll see the sponsors as sponsors of these umbrella funds, and generally they'll want flows into the asset manager, into the insurer, etc. How do you propose that this be addressed?
Well, I think one of the real problems is we don't have a handle on costs. We don't see published figures of what the costs are of the umbrella funds. The other thing is the boards of trustees themselves don't actually have a handle on costs. And it sounds extraordinary that a board of trustees actually doesn't control the costs of their fund, but that's because the sponsor controls it. And there needs to be some fix of that, because you cannot say that you're properly governing a fund if you can't control the costs. And these are all, remember, these are all DC funds. In the DB fund, the cost is not really the problem of so much of the fund itself, but of the one who bears the balance of cost obligation. In the DC fund, it's a major issue, and I think we seem to have missed that as we've moved from DB to DC, how critically important it is because it affects performance, it affects outcome for members, and there have been studies, I don't have the figures, but costs of between, when it moves from 0.5% to 1.5%, it can have the impact of, I don't know, I can't verify this at all, but reducing the ultimate benefit by possibly up to 20%. So, unless you actually get a handle on the costs, and that's where I think regulation needs to be directed. If these entities are going to try and run it on a commercial basis, then they need to actually tighten up around their costs, because it's very easy to outsource everything, which is what trustees actually do. But if you're not able to actually control the costs, you're not actually looking after the members' interests.
100% agree with you, Jonathan. Thanks for that. John, coming back to you. So we speak about ESG and sustainability through our lens in South Africa. And we've figured out that our challenges are not dissimilar to what's happening in the rest of the world, but there are things that are unique to South Africa. I remember having a conversation at another conference where we had a representative from Rotterdam that was presenting from Rotterdam, and they were talking about sustainability. Now, their environment is completely different to ours. Of course, they had this beautiful background, and they had with the massive wind turbines behind them, and it's a different discussion that they're having around sustainability. This is something that we need to focus on. It's definitely something that we need to focus on, but our solutions are going to be slightly different. Do you agree with that? And what's been your experience of this focus on sustainability in the UK?
Well, we have a sustainable ownership team within my asset management part of the business. It's a team of about 8 people, and everything we do within our investments has to pass through that team and pass muster to get invested. And we invest most of our money internally. We don't use external managers. The only time we use external managers is on the easy, cheap stuff. So passive equities. For anything more complicated, where there's usually a very high fee, we run internally. So it's a very important lens for us. And we do try to have some impact as well. So when we talk about infrastructure, the previous discussion, the sort of investments we would look at there are, we've moved away from the toll roads and things like that of the past to things like wind turbines, solar farms, biomass plants, battery storage. So part of that climate transition as well. But also we're very keen on that sort of the social aspect of ESG as well. The value of the workforce. We've done lots of work with our sort of low pay centres and various other things, because for our members, and we're a heavily unionised industry, that's the most important thing for them. So that focus is very important. I just wanted to pick up on something Jonathan said, though. Costs, we do have a cost cap in the UK for our DC funds, particularly because we have defaulting, we have auto-enrolment, and it's 75 basis points. That has a downside as well, though, because particularly when you've got a cap, people then think, right, how can I make it really cheap? And what we've seen is this trend and move towards our very big master trusts, and our big master trusts are £30 billion now. They're getting quite significant, to around about 20 to 21 bips as being the market price, which including administration costs, which means you've almost got no flexibility to do anything interesting with alternatives or anything. So potentially the member loses out because we're not getting the best member outcomes. We're getting something that looks very cheap. And it's often driven by the wrong behaviours of, I buy cheap because I know that's the cost I will get, as opposed to the return, which is not guaranteed.
That is very, very interesting. And I guess this is that balance that we're looking for, cost versus value. And how do we actually get to the right state on that? Can Himanshu, I just want to get one more question for you. And you spoke about, low contributor coverage, and it's a problem. In South Africa, we've got a big informal sector, all right? So, are there any kind of successful examples of like do's and don'ts that you could share with us from other countries, specifically in respect of the informal sector?
And this is a question that plagues a lot of countries, and interestingly, it's also coming back as a conversation starter in European economies as well, because there's a rise of what they call non-standard employment and this gig employment, and the payroll financed model doesn't quite work there. So we're seeing coverage even falling in those traditional economies where coverage tends to be very high. So in terms of what exists is actually a range of really good experience that's emerging, and on the low side, and the range actually varies depending on how much money the government is putting in. So on the low end side, it's really the private sector which is driving the fintech revolution, where they're saying, let's make pension savings easy, convenient, and try and capture that part of the informal sector which has ability to save and would do it if it is convenient. Now, the experience there it's been tremendous to see the innovation there, but it hasn't reached the kinds of scale that you need to cover the informal sector. So sort of moving beyond that, I think governments are saying, okay, can we come in with fiscal subsidies and nudges? And there's great examples in East Asia. China has been able to get coverage of about 30 to 40% of informal sector by essentially just subsidizing the bottom 40%. India has a matching contribution as well. Rwanda, which is a success story, both in health insurance and now in pensions, they have 90% health insurance coverage. They have 30% coverage of informal sector on pensions in just 4 years since their launch. And they offer targeted incentives, so higher subsidies for the poorest. And then they offer a lot more things. So, for example, another thing that's coming up is giving a bundle, because you see, informal sector workers have very different characteristics than formal sector. Their need for liquidity is much more. And we've heard this in the conference. They'll ask you this question: why save until age 60? So here the private sector is coming in with the public and saying, can we create innovative products? And Colombia is a great example. They essentially offer a product where you can get, if you save into a pension scheme, you are going to get a lump sum package of severance benefit, disability benefit, and a death benefit. So you've suddenly made this really attractive. And besides the design, there's also a need to focus on the delivery. Because a lot of countries spend a lot of time on the design, but they don't realize you need to be able to communicate to informal sector workers, build that trust, because that's often absent. They're not familiar with these products. So you need to find ways to do that. And again, there's a lot of innovation happening in that space. A lot of people think informal sector is so heterogeneous, it's hard to reach. But that's not necessarily true. They're also very organized. If you can find the right aggregator, right? Is it cooperatives? Is it the Jua Kali associations in Kenya? We do work a lot with them. Is it banks? That's what India is going after. So you need to figure out what's your aggregator. And sort of the main, and sort of the Mercedes of this is essentially just challenging the payroll financed model and saying that, see, the payroll finance model worked because in the 80s, that is what was observable. That's no longer the case. I mean, we all are using digital payments in Africa that's rising at a fast pace. Now, whatever Himanshi consumed on Monday is very soon going to be available to, a lot of people, the governments, to, private sector. And what is pensions at the end of the day? It is a form of consumption smoothing. So if we can, rethink this whole idea of, can we use, are there other observable metrics out there that is going to, blur the lines between a formal and informal sector worker and make sure that you're tapping into those consumption sources and making sure they're able to save at least a certain part, and you subsidize the poorest, so you're essentially pre-funding your social pension.
Can I add to that? I think it's really important. that we actually have such a fund in South Africa, because we have such a big informal sector. And it's really, just to add as well, my perception is most people in the informal sector don't actually have a retirement age. And so they're not thinking in terms of, well, they need a certain amount for consumption smoothing at that particular age because they're going to work forever. And they also really, really need some insured benefits, which, and being able to, if you can profile them correctly, get the right profile, you can then actually get those insured benefits, which would really provide a good safety net.
Sounds like we've got a business case to trademark or copyright quickly before anybody else gets any ideas. Zarina, coming back to you. So we spoke about reform and the paper that came out initially in 2004, and the end goal of that, ultimately auto-enrollment, the National Social Savings Scheme that we speak about. Can you give us some insight into the future 100 pieces of legislation that you're going to make us comply with and the timing around that?
Okay, so unfortunately, I'm not from Treasury. Remember, I'm from the regulator, and the Treasury will dictate the pace of many of these pieces of legislation. But as I said, we don't just regulate for the sake of regulating. So Jonathan touched on an important aspect, for example, on costs. So if there's any regulation on costs, we've got Jonathan to thank. No, I'm just joking. But on a serious note, and I hear you, John, and I think that is why we haven't come out on, basically capping fees. Look, we have different views on it even within the FSCA at the moment, but certainly we are going to embark on a benchmarking exercise in respect of fees, for example, because I think Jonathan is 100% right. You see, the fees are complex, they're opaque. I think that was also indicated in one of the papers. I think the governance of commercial umbrella funds that was issued by Treasury in December of 2021. So that is an issue because it's very hard for members, for employers to actually compare apples with apples because of the complex fee structures. So that is something that's important. I'm not saying we're going down your route, John, which you seem not to recommend, but we certainly, that will be something that we're considering. Again, Avishal, I'm not Treasury, but look, we are looking at auto-enrollment because I think you've given some stats, but 2/3 of formal sector workers have pension coverage, but of course, the 1/3, they don't. So obviously, we need a quick win in that respect, right? So Treasury is considering, and we've provided input as the FSCA, various models. So at this point in time, we're looking at various models. For example, we're even looking at, and it would be interesting to hear John on it, would something like Nest, for example, potentially or possibly work in the South African context. And of course, we're also very concerned about our informal sector workers who don't have coverage. And the question then is, but obviously, to cover them, we need a default fund. It's not just, because I think we'll have to amend, just looking at, from our lawyer, with my lawyer hat on, you'd have to amend the Basic Conditions of Employment Act. But even if you basically provide that there must be compulsory deductions and payovers, there needs to be a fund for it. It can't be, do you know what I'm saying? All those things have to be looked at. But look, those models are being looked at by Treasury more specifically. As I said, we provide our input. Also, industry has been asked to provide inputs. If you look at, Avishal, so I hope that your inputs are there, and whoever else is here from the industry, because I think Treasury, in their paper, which they published in December of 2021, actually asked the questions, what do you think will work? So industry, we know that, there are many, many clever people here, as we've seen. So we look forward to, I suppose, to those contributions as to what will be workable. Unfortunately, I don't work for the Department of Social Development, so I'm not too au fait with what's happening with the National Social Security Fund. Avishal, I think you asked me about that. That I don't know, but certainly we are looking at auto-enrollment. As I said, a quick win to summarize is to cover the formal sector workers. The next tranche would be the informal sector workers, because of course, as a developing economy, we have a large number of informal sector workers that need coverage. And I like Himanshi's idea because as we see even with our bargaining council funds, our sectoral funds, Himanshi, I think a lot of the attractiveness or attraction is because of the risk benefits that are provided. So I think you're 100% on point on that one.
Thank you so much. John, do you want to respond on the Nest question?
Yes, so auto enrolment's been in place in the UK now for 10 years. It's a big success in terms of getting people into pension saving. However, against our sort of replacement ratios, at the moment, 50% of people will fail to have an adequate replacement ratio because of the Nest contribution levels. We haven't been ambitious enough in terms of our sort of contribution rates to make that happen. In terms of Nest as a proposition, I think it's a very good solution. It led the way in terms of having a national, a government-funded provider to do the investments and administration, really to mop up lots of very small employers. My wife happens to be a member of the Nest scheme because she works for a very small employer, and it's had a great deal of success. What we've also seen is that the commercial market has also stepped into that place. So we have about 35 DC master trusts vying for space. Now, I think they will crowd each other out in time. Probably in 5 to 10 years' time, we might have 10 left. I think Nest is definitely going to be the supplier and one of the winners in that space, though. I think it's a really compelling proposition. And it's now getting to the scale where it can think about, it has more investment choices. But it has been very, very disciplined around its cost structure as well in terms of investment. Let's say if you ever get to pitch for Nest, be prepared to go low.
Noted, noted. Brian, I just want to come back to you. I know that you and the actuarial team have locked yourselves up in a dark room for the past month or so, doing modeling around Two-Pot and what it actually means for your membership and liquidity and those kinds of things. Is there any information you can share around that? How far have you gone around looking at liquidity requirements around your modeling in respect to members that you expect to withdraw from 1 March, those kinds of things?
True, we have been locked up. It's still a work in progress, but working on a worst case scenario where on the 1st of March, everyone shows up and they want to cash in on the seeding capital. The fund does have sufficient liquidity. So we do have liquidity concerns, but they're not that big. What we're more afraid of is the administrative capacity to handle the volumes. So if I was just to throw some rough numbers, if everyone was to come forward in any year, our administrator would be expected to possibly handle 5,300 claims a day. So we need to think around the resource management about that. We need to also think about the system challenges. So that's what's keeping us awake at night. In terms of the liquidity, Sfiso and the team and the PIC have assured me that the fund does have sufficient liquidity to handle the volumes. It's just more of the administrative capability to handle the volumes. That's a bigger issue.
Thanks, Brian. Thank you so much. I'm going to move to questions from the audience. Zarina, I'm going to protect you in case anybody wants to fight with you. I think we're okay. So, sorry, Brian. Yeah.
Avisho, maybe before you go ahead, I was going to say the other thing that keeps me at night is my boss.
Noted. Are there any questions for the panel?
One over there.
There is one from Geraldine.
Thanks very much. I'll stay seated because I don't want my eye to look like Brian's eye. And whilst Jonathan can be a bit controversial, I think most people do know I'm not scared to ask a question. So I'm going to ask a question and make a few statements in between also. I'll start with the costs. And to some extent, yes, I agree with Jonathan, it is something that should be looked at. But I also do disagree to some extent in that these costs are actually published. They're published in the financial statements of the fund. It is expensive to introduce and implement 100 pieces of legislative changes. So I think we, as an industry, must strongly guard against taking the approach of changing a fund's name or changing a street's name while there are many potholes in that same street. I think how we should address it is there's certainly far more important things that we should concentrate on. We know we've got Omni CBR coming, we've got auto enrollment coming, we've got Kofi coming. We're still struggling, as Brian said. I mean, the resource capacity that's going to be needed to implement the two-pot. So whilst the costs are hugely important, all of these things that we have just mentioned does not come for free. The resource requirements attached to the two-pot is huge. It is really going to cost the industry a lot of money. I think costs need to be shifted to the side, but I also would like to eventually get to the question. Jonathan, the problem as far as the costs are concerned is that I was part of a work group, I know Anne-Marie and them are here also from Batseta, where we did a retirement fund cost disclosure project. It really is difficult to come up with a one fee for all because our funds do not work like that. It's different offerings. And if, for example, a lot of providers will give you a different cost if your administration, risk, and investment is with that provider. To now start comparing a cost for such a provider, if we talk about administration fees, with provider B, where it works on a segregation of services offering, your costing is going to look completely different. Factors such as reserve accounts and so forth. It really does become complex. I'm not disagreeing with you, but I'm saying that it is a hugely complex area to discuss. So I suppose the question is, what are your thoughts on that?
Okay, so I will say something quite controversial here, which is that you said the two-pot's going to cost the industry a lot of money. Actually, it's not the industry it'll cost the members a lot of money. It's actually in the interest of the industry, this is the controversial part, to have things as complicated and as complicated as possible because they have to charge for it and they earn money out of it. And it's a problem. As I said earlier, it complicates the asymmetry of the capability of, it makes worse the inadequacy of the trustees in trying to deal with it because they have to depend even more on their advisors, which they shouldn't in an ideal world have to do. They should be expert enough to manage all these things, actually, without having this whole phalanx of highly paid expert people around them because they are themselves expert. So quite a bit of regulation is also, don't forget, directed towards all these consultants and advisors because they now need to be regulated because of the dependency of the trustees on them. And that, so you're in a kind of perpetual increasing cycle of regulation, increasing costs, all at the expense of the members. I appreciate that it may be difficult to compare costs, but that's because people have introduced their own transfer pricing arrangements. And we need to see what those transfer pricing arrangements are between admin and investment, which, as we know, is where the main transfer pricing arrangements are. And the reason that people really should be able to see it is so that they can actually compare it, so that the market can actually become competitive. If it's too opaque, you actually can't compare anything. And I have been part of a sort of analysis in comparing umbrella funds with umbrella funds, and it's very difficult to get to the bottom of it unless you actually take into account one administrator seems a lot, the fee seems high, until you look at how low their investment charges are, which is, as everybody knows, where the main bulk of the costs are. And those investment charges are often very high because they are on a retail basis, which is really, I think, very difficult to justify, where you're dealing with massive pools of members and monies to be charging pretty much on a retail basis. So that's my short answer to your question.
Thanks for that question, and thank you for the response, Jonathan. Much appreciated. Are there any other questions for the panel? There's one there at the back. We just need a mic there, please.
Morning, afternoon. Malungelo Zilimbola from Mazi. In terms of the coffee bill implementation, and I know the timing has been pushed out and out and out and out. Can you just maybe give us a sense as to when it will be implemented? That's number one. Number two, what are the challenges in terms of the coffee bill implementation? So maybe if you can give us a sense so that we understand why there's been such a delay.
So thanks for that question. Again, and not to pass the buck, Treasury is responsible for a coffee bill, putting it basically before Parliament for enactment. Part of the challenge, though, is that, there's been a lot of comments in respect of coffee. And, of course, to try to just take cognizance of those amendment or proposals and proposed amendments, it has delayed the process. And remember, there's been a couple of iterations of coffee now. And, I think it's quite far down the line because it is with the state law advisors, which is just the process before it has to be submitted to Parliament. Unfortunately, like a piece of string, it's like a trial. I don't really know when it will be enacted because it doesn't sit within our purview. But I do know that I've been advised by Treasury that it is imminent. But whether it's going to be by the end of the year, first quarter of next year, I'm not entirely sure. But certainly one would imagine, given the fact that in respect of two-pot, the consequential amendments deals with certain parts of the two-pot ought to be before, 1 March or, by that date, by the proposed date, because otherwise there'll be some lacuna or gaps in the law. But unfortunately, I can't give you a definitive answer.
Thanks so much, Serena. Ladies and gentlemen, I'm going to stop it there. I can see Mr. Khumalo is waiting for his wine. And I just want to thank the GEPF for affording us this opportunity to participate in this panel. And I want, can everybody give my panelists a big round of applause? They've been absolutely amazing today. Great insights from international and local perspective. Thank you very much. And thank you for your time, ladies and gentlemen.
Thank you very much, Avishal. And you're right, I'm focused on my wine. All right, ladies and gentlemen, we've come to the final main item of our conference, and that is a keynote address. And we will be addressed under the theme, Reframing Finance, New Models for Long-Term Investment Management. Our presenter is Dr. Rajiv Sharma. Let me tell you a little bit about him. He is a research director at the Stanford Research Initiative on Long-Term Investing. This is at the Center for Sustainable Development and Global Competitiveness in the Stanford Engineering School. He has over 15 years of experience working as an advisor and an academic in the field of institutional investments. He's published extensively, all sorts of journals that have been used by many, many organizations such as the World Bank, OECD, and the United Nations. He's also an author, and his research interests are on the design and governance of innovative institutional investment methods and models and technology solutions for better alternative asset investment decisions. He's also advising the US Department of the Treasury and works in the investment technology space in Silicon Valley. A doctorate from Oxford University in the fields of pensions, sovereign wealth funds, and infrastructure investment. Ladies and gentlemen, please put your hands together for Dr. Rajiv Sharma.
Thank you for that kind introduction, and good afternoon, everyone. It is a pleasure to be here, and it's good to see some brave souls still left in the room for this marathon session. As mentioned, the topic of my address is reframing finance, where I'll be sharing some of the key themes from a recent book we released a few years ago, actually, alongside my co-author and colleague, Ashby Monk. And the book focuses on how we can channel long-term capital into areas that essentially need long-term capital the most. I know I'm standing in between you all, and not only lunch, but flights to catch, wine to drink. So I'll try to make this as succinct as possible, and we can continue the conversations into lunch. Do I have a clicker here? All right. Okay, so why do we study long-term investors? So we have a research center at Stanford dedicated to long-term investment organizations because we believe that asset owners are arguably some of the most important organizations in the world after governments and businesses. With over $150 trillion of risk capital around the world, this group of asset owner investors, which includes pension funds, sovereign funds, foundations, and endowments, effectively form the base of the modern financial capitalist system. Any attempt to improve how capitalism functions or addresses critical challenges must begin with a deeper understanding and appreciation for the role that asset owners play in our world. And as was mentioned yesterday by Sebastian, quite literally, the social welfare of many countries relies on these funds and their ability to execute at a high level. So what we focus on is how these funds can operate more efficiently to improve their performance. If they improve their performance, then that can mean potentially lower contributions are needed and lower costs. So these funds are, I'll just skip over a few slides here to speed things up. So these funds are inherently long-term. These organizations that are set up to make investments are meant to operate into perpetuity, and many of the liabilities extend for decades. Yet there are various factors that can pressure these funds, again, which was mentioned yesterday, to invest over a much shorter time horizon. And despite their inherent long-term nature and benefits of a long-term approach, short-termism does creep into these organizations quite frequently. Various sources have reported that the holding period for investors has reduced significantly over time. We've also seen that a greater shorter-term focus, as depicted here through increased portfolio turnover, can lead to lower returns. So while there were numerous factors mentioned yesterday that can lead to a shorter time horizon, a lot of our work focuses on this investment management process. So quite often the short-termism in institutional investment is related to a misalignment of interest between asset owner investors and the intermediaries through which they invest, given the long chain between the source of capital and the actual opportunities that do eventually get invested into. The costs of intermediation have been documented extensively, which has forced asset owner investors to think of other options where possible, or re-engage with these intermediaries in innovative and more aligned ways, which I'll elaborate on further. So importantly, as was discussed yesterday, the different characteristics of investors will dictate which methods or models they will be able to adopt for different asset classes. Those characteristics include their governance, ownership, regulations, risk appetite, and their organizational capabilities. Now, while no two funds are identical, what we've done at Stanford is to try to come up, and I guess this is the challenge with academics, come up with frameworks to simplify the problem. And here we go back to first principles, to understand what we call investor identity, to allow for a universal analysis of organizational capabilities specifically. So this universality comes from the fact that there is a fixed set of fundamental ingredients that are used in each approach to producing returns: capital, people, information, and process. How these ingredients are used differs from one investor to the next, but the general nature of those ingredients remains the same. So with capital, the nature of an investor's capital is a critical input to the production of returns, as has been discussed at length over the last couple of days. Before an investor begins considering asset allocation and portfolio implementation, it should first thoroughly understand the constraints and comparative advantages associated with its capital, and then identify any encumbrances and requirements that may limit the investment strategies that it can pursue. People. So investment performance is highly dependent on investment professionals, which is why financial services is one of the highest paying industries globally. Investors rely on the knowledge, expertise, and networks of their people to fill critical information gaps. Information. So the investment industry is essentially in the business of information processing. The challenge of running a portfolio is largely one of information gathering and then analysis. Higher quality information leads to higher quality decision making. And then finally, process. So organizations use processes to make and execute decisions. The various characteristics of these decision processes, speed, efficiency, reliability, creativity, and so on, will strongly impact how returns get produced. These processes include risk management, delegation frameworks, due diligence checklists, rebalancing rules, ESG integrations, and so on. So these key inputs combine to generate returns so that the existing pot of capital can be enlarged. On top of these inputs, what we found in the research that we've done is that there are some key enablers that help asset owner investors improve these inputs. And these enablers include governance, technology, and culture. How do these enablers interact with the inputs? So firstly, governance. As has also been discussed extensively throughout the last couple of days, we found governance to be extremely crucial for the end performance of investment organizations, as it helps to guide the delegation of roles and responsibilities, sets the rules for asset allocation and portfolio implementation, and makes decisions on hiring and remuneration. The Canadian pension governance model, which has highly qualified and professional boards, is very different to that in the United States, which often lacks the expertise required in public pension funds there. Secondly, culture. So the values, norms, and non-formalized ways of doing things in an organization are what equate to its culture. So although culture can arise organically, it's usually more effective when it's designed to align with investors' objectives and other resources. So for example, a culture of knowledge sharing can improve the flow of information and build trust between boards, leadership, and staff. Similarly, a member-first culture can ensure investment horizons are consistent with stakeholders' interests. And then finally, technology. So what we found is that strong technology allows professionals to be more effective at what they do and spend time on high-value tasks, along with some mission-critical ones. So one UK-based pension fund that we've worked with indicated that by utilizing software solutions and getting out of Excel, essentially, enable them to organize their portfolio data into a single source, enable them to have a clearer idea of their current and near-term cash flow needs, both investment-related, capital calls from their private equity, as well as member outflows. And as a result of that, they were able to allocate in excess of £100 million more to alternative investments leading to significant performance benefits for them. One of the key takeaways from the work that we've done was the importance and potency of these enablers in steering capital, people, information, and processes towards best practices. So in order to improve long-term performance, investors absolutely need to examine their governance, culture, and technology, as well as ways in which enablers can be better utilized to improve the quality and combination of their inputs to their production function. So it is against that backdrop that I wanted to position Reframing Finance, which looks at defining a more recent model of institutional investment, which we call the collaborative model. So over the last couple of decades or so, we've seen different models evolve and distinctly define themselves as key strategies that investors might adopt. Each one of these models may not be all-encompassing for an investor. That is to say, investors are likely to utilize a combination of them, and that combination will probably be determined by their specific investor identity. So what are these distinct models? Firstly, we have the Norway model, which emerged in the late 2000s and is based on the Norwegian Sovereign Wealth Fund strategy of investing predominantly in public markets, but insourcing most of the management to execute that strategy. The Norwegian Sovereign Wealth Fund is considered a universal owner in that it owns almost 1% of every company in the world. The second model is the endowment model, which is based on the Yale University endowment that distinctly has had success by investing in highly illiquid alternative assets through external managers. But the endowment is well known for executing that strategy by leveraging university faculty and students that work inside the endowment, and also its alumni network for getting access to high-performing managers and collecting information that helps out their investment process. Third model is the Canadian model, which has been alluded to already, and that's the preference of the Canadian pension funds to build sophisticated internal investment teams to invest directly, as it started out, into alternative assets. So what Reframing Finance did is we put forward a fourth model of institutional investment called the collaborative model, which is based on asset owner investors forming innovative partnerships with peer investors and external managers to achieve alignment of interest and better performance when deploying capital. What does that mean in practice? It refers to the new vehicles being set up separate from the typical GP, LP fund structure, such as co-investment platforms, seeding managers, joint ventures directly with developers to invest in long-term assets such as infrastructure, real estate, private equity. And the collaborative model is based on forming these new types of partnerships with peers or external managers, but emphasizes the need for unique relationship building strategies to be adopted by asset owner investors. From a theoretical perspective, what the collaborative model represents is a shift for long-term asset owners from having complete reliance on financial services that are part of agglomeration economies that have accumulated in financial centers to forming partnerships with like-minded peer investors located all over the world and re-engaging with intermediaries in a more aligned way to form these networked economies. So there are numerous pension funds that, and other funds around the world that have adopted the collaborative model to help gain more alignment and better performance, and I'll highlight a couple of these here. So firstly, CalSTRS, the second largest pension fund in the US, adopted the collaborative model for their alternative assets program in around 2017. One of its key objectives for adopting the collaborative model was to use innovation to reduce the cost of expensive alternative investments while increasing alignment of interest and performance. So as an example, in 2021, CalSTRS collaborated with APG, the Dutch pension fund, and Abu Dhabi Investment Authority to acquire 100% of a renewable energy development company called Arivon Energy. This is an example of where three funds collaborated together to work on achieving full alignment and essentially resulting in expanding their allocations into an area of interest, in this case, renewable energy infrastructure. As a result of adopting the collaborative model for their alternative assets program, CalSTRS has reported an average saving of $195 million annually over the past 4 years, and $1.2 billion since 2017. So the collaborative model has worked quite well for CalSTRS to date. Another interesting example I wanted to highlight is that of the National Investment and Infrastructure Fund in India that was set up by the Ministry of Finance to help facilitate investments into domestic infrastructure and adjacent sectors. So the NIF is considered a quasi-sovereign development fund, but perhaps more akin to a strategic investment fund, which is a smaller category of sovereign funds that only invest domestically, but also look to attract foreign capital to invest alongside them. So one caveat of the government providing the capital to the NIF was that the fund needed to raise the same amount of capital from other large long-term institutional investors from around the world. So the NIF needed to be set up in a way that would be, that would enable it to look attractive to other large long-term investors around the world. So it adopted the collaborative model in setting up its flagship master fund. So the master fund that they created is a long-term 15-year fund with low fees, and each investor that invested actually has an ownership stake in the management vehicle itself, ensuring true alignment between the asset owner investors and the management of the fund. So not only did the NIF use the collaborative model in formulating its fund structure to get alignment with its investors, but in the deployment of its capital, it set up platform companies in each of the key infrastructure sectors it was to invest into to allow direct co-investment opportunities for those investors as well as other like-minded investors. It's set up a roads platform, a ports and logistics platform, renewable energy platform, and an airports platform to date. In the context of other strategic investment funds, the NIF is a leader in the amount of capital it has been able to raise from other blue-chip, large global institutional investors from around the world for its domestic investors. Some of those investors include Canadian pension funds such as CPPIB, Ontario Teachers, PSP, the Australian Super Fund, ADIA, Abu Dhabi Investment Authority, and Temasek. The $4.3 billion that it manages makes it the largest infrastructure investment vehicle in the country. So ultimately, reframing finance and the collaborative model is an attempt to put forward a framework for how long-term asset owner capital can be channeled more efficiently and effectively into long-term investments that desperately need that capital. Governments can play a key role in helping to facilitate this objective, as many of the attractive long-term investment opportunities are governed or need to be procured by the public sector, namely, obviously, infrastructure assets. The NIF, in many ways, is an example of how to bring the government, long-term investors, and industry together in a way that makes everyone better off. There are certain ingredients that will make such an arrangement successful. In NIF's case, not only was adopting the collaborative model an important factor, but just as important was setting up strong governance and a strong governance model that ensured independence from government for all policy decision-making, and ensuring the investment process was akin to commercial investment processes. Sovereign funds are not the only way to achieve this effect. We've seen innovative partnerships between governments and long-term investors in other ways, such as in Queensland, Australia, where the state government partnered with the state pension fund to transfer and rehabilitate the state's motorway system, leading to significant performance benefits for the pension fund when it resold those assets. Another recent example that stretches across national borders is that of a joint initiative between the US government and the Indian government that was recently announced following the G20 meetings to help fund renewable energy in India. In this initiative, both governments agreed to put up $500 million into a fund to help lower the cost of capital for other commercial long-term asset owner investors to invest in renewable energy debt. So this is an example of the governments not only providing the capital, but other incentives to help facilitate capital flows from institutional investors into areas that are in need of it. We've also seen this actual phenomenon in other countries as well, stretching back a few years now, but the government has helped facilitate investments in certain areas of the economy. The Israeli government's facilitation of investment in venture capital funds through first loss provisions to spur innovation in that country is also an example of how governments can help facilitate investment for mutual benefits. So in closing, knowing the specific characteristics that define an investor's identity is crucial in understanding what models should be adopted by any particular investor. And the collaborative model is the latest, I guess, distinct model. There are many models out there. I've identified a few here, but the collaborative model is the latest distinct model that is emerging for this group of long-term investors, which is based ideally on achieving greater alignment of interest and performance, while also having extra benefits for society as a whole. I'll pause there and welcome any questions from the audience. Any questions? I think everyone is ready for lunch.
Thanks for that. Maybe in your key takeaways there, I just wanted to have your thoughts on, the role or extent of regulation in the approach or model taken that, an institutional investor will ultimately choose. I think in a discussion I had after Sebastian's presentation yesterday was, one of the key aspects underlying, the success of the Canadian model was, the regulatory environment there, was a bit less rigid around, your mark-to-market type of restrictions and things like that. And as a result, the pension funds there have the flexibility to invest in infrastructure to the extent that they have. So, what are your thoughts on the role of regulation in how a collaborative model or any other model, how would the choice be influenced? Thanks.
Yeah, no, that is a good point. I think, that goes back to that framework of knowing the investor identity. And, it comes down to the capital, the nature of the capital. The Canadian sort of model does have less restrictions on how that capital can be deployed. In Norway, as an example, they are mark-to-market, so they don't invest in illiquids as much. They've gone into real estate a bit more recently, but that was an inhibitor for them. So absolutely, the identity of the investor and knowing the framework with which an investor is operating is crucial for which model is going to be adopted. And you see that around the world. And that's why, having an understanding of that identity is crucial. And it's not a matter of adopting the Canadian model or these other models. Each investor has their own unique identity. And it's important to understand what those restrictions are, but also what those comparative advantages are that you can leverage to create your own model. And so I think the framework is there to sort of look at what has happened and look at the pros and cons, but it's really up to the individual investor to understand the benefits that you as an individual investor can have in your own jurisdiction, to leverage your benefits as well.
Dr. Sharma, thank you very much for this. The PO and I have been arguing for almost 6 months now about the best possible model. And I think he scored one against me today because he's been punting the collaborative model in my head. And I see, government of India did this. Are there any success stories that you can share with us? Because I'm not very familiar with that particular. But just share what happened. Just say a little bit more.
Yeah.
You can use the next half an hour or 30 minutes. Please, take your time.
Sure. Maybe I'll spend 29 minutes on that and then the rest in the lunchroom. Yeah, I mean, we just, in coming up with these frameworks, we saw a trend, in the industry, and it essentially stemmed back from the global financial crisis of 08-09, where there was this dissatisfaction with perhaps what service providers were giving, and that spurred a lot more direct investment. But direct investment is not always suitable for all investors. And there is a lot of considerations that one needs to take into account. The collaborative model, I guess, is something that emerged where it was a sort of hybrid between going into like external managers as per the Yale model and the Canadian model, where you can form innovative partnerships with your peers. And it doesn't necessarily need to lead to deployment of capital. The collaborative model is about knowledge sharing. It's about cooperation with your peers, with the underpinning being that your peers will have essentially the same DNA, that you can actually have a greater understanding. And we've seen that happen a lot more amongst the more sophisticated investors, but there's no reason why less sophisticated investors, can't do that. Again, it depends on the identity of those investors. But we're starting to see these examples. The CalSTRS example is a good one, where they made that shift, and they've started to see the benefits of that through cost savings specifically. But it requires, a level of thinking that, to look at the status quo and to sort of understand that might not be the best way, and to innovate around that. And the collaborative model, the proof will be in the pudding a little bit in terms of the results over time. It's a long-term sort of strategy, so we'll have to see how it pans out. But it's starting to define itself as an option where some of these other options might not be as suitable.
Hello, Doc. Thank you. My name is Rufaro from ABSA. Just looking at the collaborative model, this tends to seem like it had validity in a time where globalization was moving forward. Now given, the minister mentioned what happened to us with the boat with Formosa and the chairman over there. How do they navigate the collaborative model moving forward in a time when you're told who you should partner with? India just happens to be good friends with the US right now. What happens in the world where they're seen to move towards China? Does that model have validity? You know how long these things take to put on? It probably took 3 years to put that in place. So how do you see your model moving forward in a climate like this?
Yeah, no, that's a good question. This model is not restricted to cross nations as well. There was a discussion earlier today. I think the word collaboration was mentioned numerous times within the country. And so it's a concept, right? It's a concept that has involved cross-border collaboration, but it doesn't necessarily have to. When the geopolitical environment is suitable, then maybe, that's the nature with, a lot of investments as well, right? Infrastructure has that issue with political cycles. There's risks associated with it, but I think that overall, as a large institutional investor of a certain size, most of them are, well, particularly the Canadians, they're global investors, right? I think the quote yesterday was that 80% of CPPIB's assets are outside of the country. And so I think that that's just a natural sort of, side effect of the strategy that the investor has already sort of gone through and has bought into. So, these are just considerations that need to be taken into account, as you would sort of need to consider currency hedging and things like that. So, yeah, no great answer to that, but you know, I think where there's a will, there's a way in many ways.
Thank you. Could you speak about what it takes, which types of funds and what it takes to do the collaborative model well? And the reason I ask is, there's a reason why we see a lot of LP-GP structures for many funds. Being a co-investor is hard. I mean, the GPs do a lot of the work for you in sourcing deals, managing the deals, and you come in and provide capital as an asset allocator. Being a co-investor is not easy, right? Because you have to bring something to the table that justifies why a GP would want to work with you, next to you, as opposed as for you. But in some cases, as you said, it can make potentially a lot of sense. Could you perhaps, as a result, elaborate a bit more about what does it take to be a successful collaborative model investor?
Yeah, I mean, I think in many ways it's a mindset to just think outside the box in many ways. And like I mentioned, I think it doesn't necessarily need to result in deployment of capital. We've seen investors have strategies around collaboration, of knowledge sharing, of secondments of staff within organizations to other peer investors. And that's part of that knowledge sharing. And it's really just about, you know, grouping together as peer investors because you have that similar DNA, perhaps more so than what you might have with an asset manager, you know, related to those items that I outlined in the investor identity, right? Culture, governance, mindset. And then when it does come to deployment of capital, absolutely, the things that, you know, are required, you know, from a sophisticated investor that's doing direct investment are in most cases required for that collaborative model when it comes to co-investing. Having those internal resources to be able to be a good partner in those co-investments is also important. So, you know, it just depends on how the model is being adopted for a particular for a particular investor, and the characteristics of that investor will dictate, you know, how much of that collaborative model, you know, will be utilized. I know John at Railpin has adopted the collaborative model for private equity. I don't know if you had some extra comments that you wanted to share in your approach to adopting the collaborative model for private equity.
Yeah, we've partnered with two other organizations originally, Alaska and Kuwait, in terms of delivering a model, really to bring some of our expertise and saying we thought we'd lost a lot of value in terms of inherent in the carry and various other things in the private equity model, and how could we deliver some of that back to our members. And of course, we're a member-based organization. Our members pay a fixed cost of all the costs, including deficits. So it's very important that we make every pound work as hard as possible. So we decided actually seeding some of these managers on strategies that we would like to do, and taking an ownership share in them was the important way that we're going through. So actually, while we've allowed one of the investment arms of our three original partners, now there's fourth and various other people have joined, to be the key investment arm, we all take our intellectual capital in that. We're very aligned in terms of what we want to get out of this, and ultimately we're doing this for the member, we're doing this for better outcomes.
I think there's one at the back there.
Yeah, thanks very much for that very nice presentation. I think my question boils down to how we can leverage the collaborative model when we look at different sources of capital. I think one thing that we haven't spoken about today is the diasporan capital, which obviously India and Israel has used very, very effectively to create those sort of fund structures. So how do you see that working in an environment where Africa does have quite significant diaspora capital? I mean, we're talking about $100 billion coming into the continent from the African diaspora just on remittances alone. So how do we create innovative structures through your collaborative approach in trapping those capital into maybe co-investing with some of the pension funds or creating vehicles that allow that capital to be deployed into other areas?
Yeah, I mean, I think the way I would answer that is just, you know, taking sort of, you can't compare one place to the next in its entirety, but you can sort of look at lessons that are relevant, and I think the lessons from some of those other places would just be that who are you looking to attract that capital from into a certain vehicle, and designing it in the way that resonates so strongly with those investors. So the India example, it was clear that if they set that vehicle up as a typical GPLP structure, 2 and 20 private equity fund structure, it wasn't going to work. It was not going to attract the scale of capital for a new manager in an emerging economy. That wasn't going to work. So they had to think outside the box and look at what was going to resonate with those types of investors specifically, and that's why they adopted and leveraged this alignment of interest concept that enabled them to design the vehicle in a way that was going to resonate strongly with those investors. And so, you know, I think that's, as a principle, what needs to happen in any, you know, jurisdiction that is trying to set up something similar. It's got to look at the objectives. It's got to have those right sort of ingredients to be able to attract, you know, whatever capital is required, you know, for that entity. I think that's it.
Thank you, Thank you very much. All right, Doc, you are correct. There's lunch, there's sun, and there's wine. And we are now at that point. Thank you so much, ladies and gentlemen. Thank you so much to Dr. Rajiv Sharma for that presentation and also your participation, notwithstanding the time of day we are at on a Friday. I would like to now call on stage the Principal Executive Officer of the GEPF to make some closing remarks, Mr. Musa Mabeza.
Dr. Sharma, thank you very much. I'm thanking you because the last presentation talks to a very important discussion we've been having within the GEPF management and the board as well. And it was also part of the panel discussion this morning. So we will take it forward. Ladies and gentlemen, it has been an incredible conference. As much as we've lost a few people, because this is the graveyard shift, I'm pleased with the outcomes of the last 2 days. You certainly did justice to our vision of a platform that stimulates dialogue on the opportunities and the challenges facing the pension industry. We appreciate your openness to debate, challenge, as well as to provide solutions to the vexing issues that we face as a pension industry. We hope that this year's pension conference provided you with all the opportunities to engage on the challenges that we face, as well as a quest to grow and safeguard the retirement industry, as well as the benefits, as well as enhancing benefits administration for our funds. Before I formally close, I would like to inform you that this conference will be broadcasted live, well, after the conference by Asset TV, who've been with us over the last 2 days, and they've been conducting interviews outside. So it will be available online on the Asset TV platform. And I want to say thank you to Marlies and her team from Asset TV for their support of this event. Ladies and gentlemen, the GEPF is committed to play its leadership role in the retirement and investment sector, whether it's in South Africa or Africa or the global stage. We'll continue with our leadership role in an industry that holds the key to a better future for all. Ladies and gentlemen, we have come to an end and a formal closing of the GEPF Thought Leadership Conference. Once again, thank you for an excellent 2 days. It is our belief that bringing together the knowledge, expertise, and experience from across the globe, you will yield a unique combination of strengths and insights in the pension industry and prepare the industry for a better tomorrow. Thank you for contributing to the conference and making it a major success, and that you have taken the opportunity to make new friends, reconnect with old friends from last year, as well as connecting with decision makers and partners for your continued success. A special thank you to the speakers, moderators, and panelists. You all did a sterling job. A round of applause to all of them. The contributions that you have all made have given us food for thought as we go forward to tackle the challenges that we face. Thank you to our program director, Andile, our appreciation for the manner in which you held the conference together. A round of applause to Andile. Thanks as well to the logistics team and all the people behind the scenes that pulled this wonderful event together. A round of applause. And before I thank the team that put the conference together, a big thank you to my board of trustees for the support, the GEPF executive and staff as well. The content behind the GEPF, the management of the GEPF is all made possible because of them and the support of the board. So thank you to the board as well. And finally, to my team, headed by Babs Naidu, Matau, Smanga, Sonke. If I leave anyone out, please forgive me. But thank you very much, guys. This is appreciated. This is the 5th time, yes. And the feedback we've been receiving after last night, I hope this has nothing to do with the cocktail party, but the feedback we've been receiving on the content of the conference, the cocktail party, the speakers, the depth of the conversations has been positive so far. So thank you, Babs and your team. A round of applause to them as well. Ladies and gentlemen, it is with a sad heart that I have to close this conference. However, we look forward to seeing you next year. Please stay safe, collaborate, and let's transform the pension and retirement fund industry. Stay safe. Thank you.
Thank you very much, Musa, for that. Ladies and gentlemen, just a couple of final words from me. Thank you so much for having me. But more importantly, I'm here to remind you that you will be receiving an email that will have a link for you to please give us feedback. As Musa has already said, this is our 5th year. We want to make sure we are here for 50 more years to come. And a little birdie tells me that next year, Mr. Principal Executive Officer, we may be adding a golf day to our proceedings. And I am told by my real bosses that please make sure that next year, for those who are traveling from abroad, you add an extra couple of days because we might be looking to you to join us in more outdoor activities. And also for those that are willing to contribute and donate to the cause, we'll be doing this as a charity golf day where we will raise the money and give it to a worthy cause somewhere in our country, because as we all know, there are those that are less fortunate than ourselves. From me, Andile Kumara, I'd like to thank you for your attention, and we're now breaking for lunch.